Statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. They need our money.
A very subtle sign that China might be ready to come to that table. Up next on the program, Bloomberg's Tyler Kendall, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Snapped a two-day winning streak on the S&P 500 in yesterday's session. The declines continue on the S&P. We're negative here by 0.75%. On the Nasdaq 100, we're down by 1.45. Three things to watch a little bit later. Down in Washington, D.C., look out for this. Trade talks between the United States and Japan. And the president telling us this morning he will attend those talks. Later this morning, 8:30 Eastern Time, U.S. retail sales. And then Chairman Powell addresses the U.S. economy at the Economic Club of Chicago at 1:30 Eastern Time. Just keep those things on your radar. Under surveillance this morning, pushing for China to come to the table.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
So here's the latest this morning. The team here at Bloomberg reporting that China is open to trade talks if the White House shows more respect and is willing to address their concerns on Taiwan. To discuss is Bloomberg's Tyler Kendall. Tyler, busy morning already. Negotiations potentially with China, and they're going to happen with Japan later. And then the prospect of a legal challenge out of California.
Yeah, hey, John, a lot going on here, a lot of different levels to this as the administration pushes forward with its tariff plans. And we're learning, as you've mentioned, that a person familiar with the Chinese government's thinking telling Bloomberg News that the most important precondition for talks is that Chinese officials feel that they will be treated with respect. It appears that Beijing wants to start to see President Trump disavow comments from his cabinet members when they are critical of China. Now, you mentioned there President Trump saying in the last hour that he is going to be engaged directly with Japanese negotiators. We're learning that China wants to see the U.S. instead appoint a specific point person that can act and speak in President Trump's capacity. Even as the White House says, President Trump wants to and will be involved in these negotiations directly. President Trump's meeting today, he's going to be alongside the Commerce Secretary Howard Lutnick, as well as Treasury Secretary Scott Bessent, who told Anne Marie earlier this week that negotiations with China can be particularly tricky, considering that China is both an economic competitor but also a military rival. And you heard President Trump say in his post on Truth Social that they are going to also be talking about those national security and military matters in these conversations as well. Because, John, while tariff barriers against China have now reached, of course, record highs, we're going to start to hear a lot more about escalation when it comes to those non-tariff barriers. Take, for example, China looking to both restrict but also in some cases completely suspend its exports of critical minerals to the U.S. And just yesterday, the U.S. formally announcing that Section 232 investigation into critical minerals and rare earths, the latter of which the U.S. imports about 70% of its supply from China, was widely seen as a move to try to pressure Beijing to the table.
Tyler, what can you tell us about Gavin Newsom's new legal challenge to the president's tariffs?
Well, it appears, it hasn't been filed quite yet, the complaint, but it does appear that Gavin Newsom is trying to make this argument that the tariffs against Mexico, Canada, and China, that initial batch, are harming consumers and businesses. We should say that, of course, this is coming as a challenge to how the president invoked IEPA, the International Emergency Economic Powers Act, and we've actually have seen some other lawsuits against this when it comes to the so-called reciprocal tariff plan on two bases. One, that the emergency invoked for that, which would be the trade imbalances, doesn't rise to the level of a national emergency. In this case, it would appear that California is saying that the fentanyl and immigration might not rise to the level of the emergency. And then, of course, the second part of this is that IEPA actually doesn't explicitly state that tariffs can be evoked. So those are potentially two legal paths that we could see happen here. But we should also importantly say that in the past, the courts and the justice system has really broadly given presidents the authority to invoke national emergencies and often sides with them in these cases.
Hey, Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Thank you. We had this conversation a little bit earlier this morning. Let's just sit on the U.S. and China. The prospect of China coming to the table, even if they do, it could take a long, long time, way more than 90 days, to come up with an agreement with the Chinese.
Which raises this question, do you just keep getting a pushing back of some sort of negotiating timeline? Or is there going to be some real disruption in the meantime that you're already seeing companies gird for in terms of supply chains and trying to stockpile goods?
Alicia Levine of BNY Wealth still with us. Alicia, let's get to this. If you don't know how long talks are going to last, what do you do in between? We keep hearing this phrase, wait and see. What kind of CapEx decisions can you make in the meantime?
So we're very concerned about that because already intentions to invest and intentions for CapEx have dropped. If you look at all the survey data, that's what we're seeing. So it's a pretty brutal policy in terms of forward investment. And that's really where the problem is coming, that each day that this goes on and time is just not on the side for the real economy, you know, just as a reminder, the market always bottoms before the real economy does. It happened in COVID. It happens all the time. It's just to remember that that's out there. But there is real damage happening today, right now. It's great that China and the U.S. are negotiating, but it's impossible to make a decision if you're a COO or a CFO where to put investment. It's impossible. And so I'm concerned that you might have a freezing in the real economy here. I think the risk is real, and I think it's happening right now. It's certainly the damages to small businesses are beyond, right? So the interesting thing, the challenge from the governor in California is really the first major IEPA challenge that we've seen since policy was announced on April 2nd. So it's actually amazing that there haven't been more. It hasn't been immediate, but I think the administration knows that IEPA is a little bit more on shaky ground, which is why they're putting pharmaceuticals and semis under 232, right?
There's this other question. It's not just how this trickles out into the actual economy. It's Are there certain sectors that are going to be so exposed so as to be not really desirable for you? I'm thinking of auto manufacturers or retailers.
Yeah, look, but for that, in terms of an investment thesis, you just really have to look at how far the stocks have fallen and where the multiples are. Because there is a price at which you pay because it's been completely de-risked. So the auto sector looks like it's been completely de-risked here. You know, the market's very efficient in pricing it with the worst case scenarios, and I think we have it. Again, we have to remember the markets always bottom before the real economy does. So sentiment data has been rock bottom really for about 5 or 6 weeks now. Again, the American public knows the word tariff, which I find fascinating because sometimes they don't know who the defense secretary is. And so we've seen the sentiment data really be terrible. The issue is, can the hard data at this point declining do more damage to markets than what we're already anticipating? And as investors, that's where we have to live. We've gone neutral on equities. We've moved some of the allocation to short-term fixed simply because we too are really uncertain. And it's very hard to have conviction except on price and valuations.
President Biden forgot who the defense secretary was once upon a time. Do you remember when we lost him? For about a week.
He was lost because he was under anesthesia. Yeah, that's right. And then he didn't call the White House to tell them he was going to be under anesthesia. So, yeah, I think it was 24, 48 hours.
Is that how long it was?
We lost the defense secretary.
Got to find space for jokes here, Bramo. Alicia Levine of BNY Wealth. Alicia, it's good to see you. As always, thanks for dropping by. Up next on the programme, we'll catch up with the former House Majority Leader Eric Cantor as Wall Street looks for some policy stability. Are we getting signs of things just kind of cooling down? Just a little bit. Equity futures on the S&P 500 at the moment negative by 0.8%. Lisa, in focus this morning, the chip makers.
Yeah, and how they can really withstand some of the uncertainty that's ongoing, even as they prepare for the ongoing restrictions. That's not good enough, as we learned from H20 over at NVIDIA.
In just a moment, Danny Berger will break down some of the movers in the pre-market. Live from New York City, you're watching Bloomberg TV.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The chip makers in focus this morning. Equity futures negative across the board. On the S&P 500 down by 0.75%. On the Nasdaq we're down by 1.4%. With your movers going into the opening bell about 2 hours away. Here's Danny Berger. Hey, Danny.
Hey, John. And here's that company that's causing the rupture in chip makers. It is NVIDIA this morning, down 6.33%. Reporting yesterday that they would be taking a $5.5 billion charge because their H20 chips, remember, these are the chips that they specifically designed in order to get around export controls to sell to China, are now being targeted by the Trump administration and are now themselves facing restrictions. So a big blow from them, bringing the entirety of the sector down with them. Meanwhile, you also have United on the upside this morning, up 7.33%. Maybe this is the new playbook for companies that are uncertain to their future. They keep their outlook for the year, earnings as high as $13.50 a share, but they say in the scenario where there's a recession, it will roughly have to about $7. You can see the positive share reaction. That contrasts with Delta Frontier last week, who completely upended, got rid of their outlook for the year, and those shares fell. But this morning, it's a positive story for the airlines. It is lifting the rest of the sector with it, given that it's given the market a floor. Rounding things out with the Reuters report this morning on Tesla. Sources there telling the outlet that Tesla will stop importing products and parts from China for their Cybercab and for their semi-electric truck. Those shares falling 1.9%. It hurts their efforts to really mass produce these things. It will be on pause for an indefinite amount of time. Again, sources there saying that they could handle the 34% tariff on China, but at the current levels, they just can't absorb the costs. John.
Danny, thank you. Tesla down by about 1.9%. On our radar this morning, China signals it may be willing to come to the table on trade. Sources telling us here at Bloomberg that Beijing is looking for certain conditions from the Trump administration, including a more consistent position on trade.
And also a little bit more respect they're talking about. They want to rein in some of the comments, like I imagine what they're talking about, as we recently heard from Vice President J.D. Vance talking about Chinese peasants. Interesting, though. They want, Jonathan, what you said Wall Street wants, what Jamie Dimon wants, a point person to do these negotiations. Scott Bessent, the Treasury Secretary, said to me they will start from the top. Before you get a meeting between Donald Trump and Xi Jinping, there's going to need a point person to try to bridge the gaps in terms of a trade deal, especially when it's more than just trade. It's things like TikTok that might come into the discussion in the negotiation.
If the Japanese negotiations are a template for what's to come, it's going to be President Trump with Scott Bessent and Howard Lutnick all in the room at the same time. If you need a note taker, I will take notes. I will just sit there quietly. I would like to watch. I am curious how that's going to go.
I think it's going to be very interesting, given that there's one man that this market would like to see more of, and another man that this market might want to see less of in the coming weeks.
The market wants to see more Scott Bessent. They are very happy that now he clearly is in the driving seat when it comes to trade negotiations. I asked him, he had told me after Liberation Day, Jonathan, that he was not part of the negotiations. He clarified to me this week that he didn't mean he wasn't part of the negotiations. He wasn't part of setting the tariff rates. It was a signal that he is now in the driving seat to bring these tariff rates down. I have to say, though, if I was part of the Japanese negotiating team today, I'd be very nervous. You're going in with the President of the United States, not your direct counterpart. And I imagine the Prime Minister feels a little bit left out.
It's probably not what they were expecting, that's for sure. Loved the conversation you had with the Treasury Secretary. Could sense the frustration he had that the overwhelming focus of the press at the moment was only on one stool of the policy platform. So let's talk about another leg of that stool. Let's talk about the GOP, considering a new tax bracket for millionaires. Sources telling us here at Bloomberg that House Republicans are proposing a new 40% rate for taxpayers earning over $1 million a year. The White House officials saying the president is actually open to the idea.
They're open to this. You have Senate and House aides and White House aides talking about this. They're drafting it. One thing is key, though, in our story. This White House official said that Trump is open to this idea of a new tax bracket. However, there was an emphasis that the higher rate should kick in at a threshold far greater than $1 million. And to be honest, this is what I've heard from people. Maybe there's a new tax bracket, but for people that make hundreds of millions of dollars, not just that 1 million threshold.
I'd love to know how many people earning hundreds of millions of dollars will actually pay that, because I imagine they had an army of accountants doing their tax returns. They don't do their tax returns like we do our tax returns, right? They've got an army of people working on those things.
Yeah, they'll deduct the factory that they built to fuel their kitchen and the house that they built and then the other house that they built. Look, the fact that this is being proposed highlights the perennial issue, which is that everybody has a money problem in Washington, D.C. You need more of it because right now deficits are going up, and the proposals that they have would only deepen those deficits.
A couple of things to watch later this morning. We talked about retail sales. That's due in about 60 minutes from now. Also this from Fed Chair Jay Powell, 1:30 Eastern Time from the Economic Club of Chicago. His second public appearance since President Trump unveiled sweeping tariffs on April 2nd. Will this address be any different?
You know, at a time when you're hearing from other Fed officials, there is a real debate about how much this Fed is going to raise concerns about anchoring inflation expectations versus going after some perceived weakness as you see a bottoming out or rock bottom types of sentiment in some of the soft data. Very difficult one. It is also difficult to take anything completely literally, considering that he is also messaging to a market where he wants them to believe that they're going to take a very firm hand when it comes to inflation.
The Fed Chair speaking at 1:30 Eastern Time. Let's get to this. Wall Street's biggest banks looking for some clarity on policy. JP Morgan's Jamie Dimon urging Trump to start talks with China and telling the FT, quote, "We should be careful. I don't think anyone should assume they have a divine right to success and therefore don't worry about it." Joining us now to discuss, the former Republican House Majority Leader, Eric Cantor. Eric, welcome to the program, sir. Welcome back. It's good to see you.
Nice to be here, Jonathan.
Let's reset. What do you make of the approach from the administration to trade over the last few weeks?
Well, listen, I mean, there are so many, there's so much noise, so many signals coming from the White House right now. I think that market players are just, sort of trying to take a step back and figure out if they have a portfolio of companies, what it is that they look like, if they're import sensitive. Obviously, there's now a little bit more focus on what's coming out every single day of the White House. I think the imperative for the president and his team today, as they're meeting with Japan, is to demonstrate success. I mean, this is where I think people are looking for some amount of clarity in that, what does it mean when we're supposed to be enduring some pain? And the president's been pretty clear, saying, hey, we're going to change sort of the trajectory of the country. We're going to strengthen the foundation. And if that's the case, what does it really look like when he's dealing with a counterparty? And if it's Japan, and I would say even India, because India is the one that is most protectionist that comes to mind. If we can demonstrate there's an opening up of that markets, that this is what it's all about, I think that that would calm some nerves right now.
Are you convinced that is the metric for success?
Well, I think, there is, Lisa, you talked about sort of taking him literally, taking him seriously, or hinted at that in what you just said. And I look at this term of the Trump administration somewhat differently than the way we looked at the last one, in that almost he is sticking to his literal word when we're talking about tariffs and trade here. So, Jonathan, back to your question, if he's about trade deficits, because that's been one of the real metrics that he's put out there consistently, that's what it's about. So are we going to see the Japanese buying more of our goods? Are we going to see that along with the opening up of their markets so that our exports can flow into these other countries?
The president ran, though, on getting everyday goods down in prices, things like groceries, things like gas. A recent CBS poll says a majority of Americans see tariffs adding to prices, adding to inflation. Can they wrap this up before the midterms?
Well, this is and then this brings up the last point I think that's really important about today, and when we look at Capitol Hill when Congress gets back. I think the administration and the Republicans need to act with dispatch. It's important that there is some success under the belt demonstrably, so the markets see that in terms of dealing with countries. And I think from the Republican standpoint in Congress, they've got to get this reconciliation bill done. Simplicity is their friend right now. Adding additional taxes, doing those kinds of things is going to take weeks, if not months, to bring everyone on board. And I think if we can just extend what President Trump had said was the greatest tax bill ever, 2017, they should just go ahead and do that.
If I had said to you, Congress right now is debating whether or not to raise taxes on people that make $1 million a year, would you think that came from a Republican or a Democrat?
It is an extraordinary concept coming out of what I believe is still a very pro-growth party. I think you've been discussing this morning the three legs of the stool of the Trump economic plan. One of them is taxes, the other deregulation, along with the trade agenda. All that has to come together to help growth in this country, to see incomes rise, wages, growth, wealth, all of it, opportunity. And to sit here and say that we are going to be increasing marginal rates on individuals, that ends up hurting small businesses. I mean, that's the trick there. When they start talking about millionaires, remember, we've got a lot of people in this country that file taxes that have sub-S or LPs or that are taxed at the individual level, but actually run businesses. And I don't think they're going to get too far with that concept.
But what if they do? This is a pillar of conservative orthodoxy, not to raise taxes, period, on anyone. What do you make of the party and the direction of travel if they were to go ahead with this?
Well, again, I'm not sure that they're going to go ahead with this.
But they're discussing it right now.
Well, I'm not so sure how widespread that discussion is and what kind of enthusiasm there is. But this is not a pro-growth item. And I think more of the focus is going to be on how they come together on these pay-fors, because we saw, again, the important data point that occurred last week was the bond markets. You know, we saw the concern there about the fiscal health going forward. And I think it's really important they focus on that so they can act with dispatch and get these tax rates extended.
Heading into this year, the belief was that President Trump was going to be a pro-business president who was going to focus on fiscal responsibility as well as celebrating national champions. We have seen policies that have reaped the opposite consequences in markets. Do you think that this president is still pro-growth?
I do think he's a business guy. I mean, we all know he's a real estate developer from New York City that was very successful and had times here where, just like any in the real estate business, there are ups and downs. But he has demonstrated the ability in business to create wealth, and I think he wants to do that for America. And so, yes, I think he is. Now, what he's going about doing in reordering our economy and trying to sort of rebalance, if you will, the balance of trade, as well as the burden sharing that occurs with us and our allies, importantly in the financial realm as well as the defense realm.
Although you have a unique position because you wear the hat of both being in government, in a leadership position, and also talking with tons of companies while being vice chair of MOLIS. Do they have the confidence to invest? Do they feel like they can be expanding right now and have confidence and conviction that ultimately this whole mix will benefit where they're heading?
Well, I mean, I would say, first of all, we're still America, right? I mean, there is still this unbelievable country that we've got with, and we can go through the various aspects of what draws capital and investors here, rule of law, transparency, you name it, innovation, the rest. We're still that. The Trump administration understands, the president in particular has said the biggest asset we've got is this huge consumer market that the world now has tooled up to take advantage of. And he's trying to use that to go in and create a more stable trajectory longer term, both from a fiscal and economic standpoint. So I think, listen, right now as we started, there's a lot of signals that are creating this sort of question on the minds of individuals, whether they are strategics, whether they are sponsors, and how to go about in terms of conducting their business. And that's why I say, again, really, really important that we see manifestation of success. You know, the president's really good at communicating. I hope we can see some communication of success and that people will begin to understand what the trade-off here is.
This is ambitious stuff. Let's finish on this. Governor Juncker was in your seat yesterday, and we asked him this question. I'll phrase it differently. At the moment, there are two very left-wing politicians in this country filling stadiums, getting support, at a time when the Democratic Party is an absolute mess and support is rock bottom. I get that. But do you worry that if the president isn't successful, that in a number of years' time, this pendulum could swing aggressively to the left? If the right can't provide the solutions, does this country seek out solutions from the left?
Look, all I know is the left is so in tatters, and the one pillar that they've got of any kind of unity is so extreme on the cultural side and the design of where they see the world. There is no way that the mass of this country in terms of an electorate is going to adhere to that extreme Bernie Sanders AOC agenda. There is just no way. Now, not to say that there will be unhappiness if we don't see success, again, which is why I come back to the point it's important that we act with, that we see some urgency and acting with dispatch in Washington.
Because you understand the risk here. To bring up the EM example, that you swing between Bolsonaro and Lula, and you start to resemble what we see in Latin America repeatedly.
We are America. We are America. We are not Brazil, right? So we have a long tradition of continued institutional guardrails, protections. We have the deepest, broadest capital markets there are. I still believe that we can get through this. Again, as you said, this is a very ambitious goal that the president has set out to sort of rebalance. It is where we can head, and the fact that there have been some people left out. Yeah. And when you talk about these stadiums that are filled by Bernie Sanders and AOC acolytes, it is those people that are looking for the answers, and frankly, a lot of sort of people who feel left out, if they're at those stadiums, they are looking to the president to deliver on the promises that he's made.
It's an ambitious agenda. We've said it repeatedly on this program for the good of the country. We hope he's successful. Eric, it's good to see you. Thanks for dropping by. The former House Majority Leader there, Eric Cantor. Equity futures at the moment just about negative by 0.6%, with an update on stories elsewhere. With your Bloomberg brief, it's Danny Berger. Hey, Danny.
Hey, John. The EU Chamber of Commerce is calling on China to make significant changes to its economy in order to avoid further backlash and build economic ties internationally. The chamber said that China's industrial policy framework needs to be changed, urging the country to return to market-oriented reforms to allow Chinese and foreign companies to compete on a level playing field. President Trump has threatened to revoke Harvard University's tax-exempt status after the school refused to change its policies. The university has rejected the administration's calls to make changes to policies, including school leadership, admissions, and diversity. In a post earlier this hour on Truth Social, Trump called Harvard a joke and said the school should no longer receive federal funds. Zoox, the autonomous driving tech company owned by Amazon, is preparing to begin testing its vehicles this summer. Zoox will add Los Angeles to its 6th testing location, laying the groundwork for future commercial services, a company spokesperson said. Zoox was founded in 2014 and acquired by Amazon in 2020. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny in the next hour. Up next on the program, consumer caution.
We were already in an economy that was slowing before all of this tariff uncertainty. You're going to see some movement up in the unemployment rate. Sadly, that's a consequence of a higher inflation, less growth environment, and I think that's going to be the case that leads to even more caution on the part of consumers.
In just a moment, we'll talk about the consumer and housing. We'll catch up with Alan Ratner of Zellman & Associates from New York City. You're watching Bloomberg Surveillance.
case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
The consumer in focus this morning, 8:30 Eastern Time, U.S. retail sales. Equity futures going into that negative by 0.6%. On the Nasdaq, we're down by 1.3. Under surveillance this morning, consumer caution.
We were already in an economy that was slowing before all of this tariff uncertainty and the implementation of massive tariffs across most trading partners. That's very important. The pillars of the U.S. economy were not collapsing, but they were becoming more fragile. You're going to see some movement up in the unemployment rate. Sadly, that's a consequence of a higher inflation, less growth environment, and I think that's going to be the case that leads to even more caution on the part of consumers.
So here's the latest this morning. Concerns about the economy impacting the outlook for housing. The latest Zalman and Associates home builder survey finding increased buyer hesitancy across the board. Alan Ratner of Zalman and Associates joins us now for more. Alan, welcome to the program, sir. Let's pick up on that. If buyers are pulling back, is that because of interest rates or general anxiety about the economy driven by the policy volatility of the last month?
Hey, good morning, John. Thanks for having me. Yeah, I mean, listen, I think this is a culmination of a really stretched and constrained consumer from an affordability perspective. You know, rates have been elevated now for a couple of years, and the housing market has kind of chugged along in spite of that. And home builders in particular have utilized a number of tools to bridge that gap from an affordability perspective. They've bought down mortgage rates. They've adjusted prices where they could. But I think you're just seeing a very tired consumer right now that has really hit the ropes in terms of their ability to afford that home purchase, given where rates are and what home prices have done over the last several years.
Alan, based on some of what we've seen proposed with respect to both tariffs as well as immigration, how much do some of the ongoing restrictions and uncertainty restrain the profitability and the profitability forecast of some of these home builders?
It's really interesting because home builder gross margins have come down quite a bit from their recent highs a couple of years ago. But the biggest culprit has been rising land costs. And the way the home building business works, home builders need to buy land several years in advance before they're actually building a house and selling a house on that land. So what you're seeing in terms of today's gross margin pressure is really a result of what land prices were doing in 2022, 2023. The good news, if there is some, is that we've seen relatively modest inflation in terms of materials and labor over the last couple of years. And we really haven't seen much change to that more recently. Obviously, tariffs do present a risk in the near term, But the good news is, from a per home basis, we estimate the impact is going to be somewhere between $5,000 and $10,000 per home. And we think a lot of that gets absorbed through the supply chain as opposed to getting pushed down to the consumer.
In the meantime, amid all this turmoil, we were expecting slower growth expectations, pushing down rates, which actually would make affordability better on the margins. We're seeing the opposite after the turmoil of the past couple of weeks, given the sell-off in longer-term rates. We saw mortgage applications come out this morning. They were down 8.5%, which is actually the biggest decline that we've seen going back to late last year. Alan, at what point do you get concerned that if rates stay at these levels on the long end, that could essentially keep this market kind of in paralysis for a very long time?
Yeah, there's no question. I mean, the byproduct of a slowing economy typically is lower rates. So, at least you could kind of see the silver lining there, that over time that could be a catalyst to bridge that affordability gap and get the consumers back engaged in the market. But if you have high rates and a slowing economy, that's a double-edged sword for the housing market. And I just don't see any potential growth in the near term in that type of backdrop.
Who's best positioned? What companies in this environment?
Well, we've seen relatively stronger trends at the move-up price points, the more discretionary buyers. These are buyers that are not as impacted by mortgage rates and affordability. A lot of these buyers are either paying all cash or putting down a very high down payment. So companies like Toll Brothers, Taylor Morrison, Pulte, these are builders that either focus on the higher end buyer or at least are diversified from a price point perspective. But frankly, the stock market volatility we're seeing here over the last couple of weeks is giving that buyer some pause as well. So there's really no segment that's immune from the volatility. But on a relative basis, we do feel a little bit more positive about that higher end buyer today.
Alan, appreciate the update. Alan Ratner there of Zalman and Associates. Alan, thank you. That last point there on Toll Brothers, even the upper income bracket has pulled back. Now, he's still confident, but even they've been affected by this, and that's something we haven't seen much of in the past 5 years.
Yeah, the wealth effect has really propelled the upper class to really increase spending pretty dramatically and uphold the whole economy, even though the lower end has pulled back. It raises this question about whether this is a forward-leading indicator or whether the housing market has been in a cycle of its own that's kind of over here that we can point to when we're trying to prove a point and basically say it's an anomaly when we don't want to make that point.
I think it's fair to say it's been in a cycle of its own for quite a while.
I think that's fair.
And not just the last 5 years, that's for sure. Equity futures on the S&P negative here by 0.75%. Coming up next, we'll catch up with Rick Reeder of BlackRock, the United Airlines CEO Scott Kirby, Tiffany Wilding of PIMCO, and Katie Kaminsky of Alpha Simplex. A big hour coming up. Lisa, we're going to be talking about retail sales at 8:30, and then later on in the afternoon, that address from Fed Chair Jay Powell.
How do you price in the unseen? How do you price in feelings that aren't showing up? That is the ultimate question underpinning all of these interviews and all of the outlooks.
The third hour of Bloomberg Surveillance is up next.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on The Close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss The Close, live every weekday.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
The market is currently making a major potential reassessment of valuations of U.S. assets.
It's not a necessary sell everything type of an environment.
I have a difficult time seeing where the genuine new positive catalysts are going to come from.
A lot is going to change day to day and week to week.
Uncertainty is high, not just for the economy, but for investors.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and this hour focused on the U.S. consumer, whipsawed by tariffs, sentiment already dropping towards a 3-year low, inflation expectations at multi-decade highs. Later this morning, we get a sense of what the U.S. consumer is doing, with retail sales just 30 minutes away. And then this afternoon, Fed Chair Jay Powell addressing the U.S. economy, attempting to offer investors some clarity with very limited visibility.
If you take a page from United Airlines, there are a couple of different scenarios, and you could drive a truck in between how big the gap is between them. There's a real question, not just on what these numbers will reveal when it comes to retail sales, but how the market interprets them, considering that they might not be pricing in the full effects of tariffs, a policy uncertainty, that as they have not trickled out into pricing and other aspects of the economy. On the flip side, from Fed Chair Jay Powell, how much can you really take from his words, given that he doesn't have any more clarity, and is trying to message a strong hand to control inflation and look forward into the abyss?
He's pledging to anchor inflation expectations. The decline that we've seen in soft data is notable. The hard data, we're not looking into the abyss right now. He's looking at the hard data and saying unemployment's still around 4%, the economy's okay. And we've heard that on repeat from the FOMC.
You know, Mohamed El-Erian talks a lot about listening to what the companies have to say. And what the companies are saying right now is not dismal. It is not looking into the abyss. It is quite the opposite. It is that other upside surprise type of potential with a consumer that is still spending, concerned, sure, sending in responses to the calls that they get from the University of Michigan saying that we feel terrible, and then they're going out with retail therapy. So at what point can you actually give some credence to the strength that we're seeing coming out of these companies?
We need some therapy from the White House. Will we get it? Negotiations with Japan a little bit later, and just a little ray of light coming out of China. Just a little bit. based on our reporting, that maybe they're willing to come to the table with conditions?
They are responding, according to our report, someone familiar with how the government in China is thinking right now, the CCP. They want respect in terms of stop some disparaging comments coming from cabinet ministries. They want some sort of deal when it comes to sanctions and potentially how the U.S. views Taiwan. I think that's going to be incredibly challenging. And they want something, Jonathan, you said earlier, that Wall Street wants. They want a point person. Now, what else do we see today? Japanese negotiations, and the president himself is going into these negotiations. The prime minister is not there. I think what China needs to start to realize is the point person might be Donald Trump himself.
It is the president. Equity futures right now negative by 0.75% on the S&P 500. Coming up this hour, we'll catch up with Rick Reeder of BlackRock as traders face fresh trade uncertainty. United Airlines CEO Scott Kirby on the carrier's dual forecast, and Katie Kaminsky of Alpha Simplex reacting to U.S. retail sales. That number 27 minutes away. We begin this hour with trade tensions weighing on the tech sector. Rick Reeder of BlackRock writing, taking opportunistic positions in good quality companies in the equity market has and should continue to pay off for investors with longer time horizons. I'm pleased to say that Rick joins us now for more. Rick Reeder, it's been too long, my friend. Let's get straight to it. I just want to understand what you've been seeing with the team over the last week or so. Have the foreign buyers of treasuries been pulling back?
So, I mean, boy, it's been an incredible period. I mean, so, you know, to start with, I mean, the Treasury market, the move back in the Treasury Friday was extraordinary. This pressure on the Treasury market, concern about international selling, that was pretty amazing. And then we bounced back pretty nicely as some calm has come back in. And then, you know, the volatility in the equity market, the daily volatility, a little bit calmer this week. Does present, you know, similar to what I said there before, it does present some opportunity in these markets. It is, I will tell you, the uncertainty, though, has led to liquidity in these markets that's pretty rough right now. When you go to execute, you got to be very thoughtful and very tactical about how you do it, because markets are very jumpy and very uncertain these days.
And Rick, typically the place you go for liquidity is the Treasury market, deep, predictable. That's why people buy treasuries. Rick, can I get your view on what you think was happening last week? Do you believe that was foreigners pulling back? Is there a question mark over the U.S. safe haven status, or is that just certain trades unwinding, things blowing up?
It's a great question. I mean, so first of all, you know, when you have this pressure on the currency market, and by the way, it's super acute when you think about equities going down the same time that the currency is going down. Usually the dollar appreciates when you're in this risk-off mode. So you've unquestionably seen the pressure on equities and international disposition of the equity of a number of U.S. equities. In the rates market, it's a bit more blurred, but there's no question about it. There is some concern. We fund so much of our treasury debt internationally. There is some concern with the currency depreciating. And then, quite frankly, the back end of the curve going through these periods of spasm where inflation is higher. You know, even if the Fed cuts, what does it do for the back end? There's an argument that when the Fed cuts, the back end becomes less tethered, and in fact, you get a steepening of the curve. So, yes, I think there's some international disposition for sure as the currency weakens. But I think broadly, it's this uncertainty, and it's just hard. You watch days like Friday. You know, it's just hard stepping in, particularly in the back end with this uncertainty still out there.
So, Rick, at what point would you step in?
So I like owning the belly of the yield curve, and I like owning, you know, the front end has gotten pretty well priced. I mean, you've got to, and I think the way you all described it, you know, the Fed, you're pricing in an awful lot of cuts for the Fed this year, and you haven't seen that hard data deterioration. I do think you'll see that in labor over the next 2 or 3 months. You'll see some pullback of probably some significance in places like healthcare and education, leisure and hospitality, but we've got to see it. But the belly of the yield curve, there's some opportunities. And quite frankly, Europe is more interesting because you don't have the inflation impact in Europe. The ECB's got to cut more aggressively. So I actually think, you know, we've seen some real opportunity. It's actually European rates, very different. And by the way, you don't have the international disposition there. In fact, that's where you have probably international, I'm sure, you have international buying. So European rates is a place recently we've liked quite a bit.
Can we take this a step further? You talk about how U.S. Treasury markets tend to be the deepest, most liquid, and then you talk about how rocky liquidity has been and how execution risk has become an increasing consideration for you. Have we gotten to the point where on some of these days, the European rates market has actually been more liquid than the U.S. rates market?
Good question. I mean, so more liquid, I don't know if more, you know, certainly the back end of the yield curve, it takes price to get execution. I don't know if it's more liquid. It certainly feels to me like you have this ballast of, you've got an ECB moving, you've got a yield curve that's already pretty steep in Europe. And by the way, if you're a dollar investor, you get a cross-currency swap benefit. And because the curve's so steep, you roll down. So, there are a lot of reasons why I'm sure others, as well as ourselves, have felt like, gosh, it's a safer place to be, even though you're going to get European funding of fiscal initiatives over the next couple of years. That just takes some time. But I don't, I still say the Treasury market generally is much deeper. But Europe, you definitely see more buyers coming in internationally as well as what we see in the States.
Rick, it seems like the picture that you're painting is a regime change. The picture that you're painting is shifting away from the United States and following a real flood of money into some of the overseas markets, and frankly, not betting that the long end of the yield curve will provide the ballast that it has in the past. Can you talk about what else has changed? Does this really undermine or reshape the way you look at 60-40 or the position of gold in your portfolio?
It's a great discussion. That's a long discussion. A ton has changed. Like you say, we've added in the portfolios, not in our fixed income, but other portfolios, we've added gold. We think gold is a good hedge generally. Quite frankly, you have to, during periods like this, you tactically hold more cash in the portfolios. We've done that. Back end of the yield curve and interest rates, and as a hedge when you've got inflation moving potentially significantly higher, not really a big benefit to the portfolio. So, and then the other one, when you get rates backing up, you can get your yield much more attractively using high quality assets. So even though, you're, some pressure on parts of the high yield market, pressures in the lev loan market, you can actually still create them in one of our ETF, this BINC ETF. We're able to create over 7% yield and actually improve the quality of portfolio, run more cash. That becomes super attractive. As long as you're not stretching, go down the credit structure into, the CCC rated high yield, you can actually create more yield today. So I like the idea, build some more cash, use some tools that are different than in the past, and then, quite frankly, just get higher quality and more liquidity in the portfolio.
Rick, do you think the rhetoric around the fact that some investors are saying they're dumping dollars, dumping treasuries, that the U.S. is losing safe haven reserve asset level, do you think that rhetoric is overblown?
I'd say sentiment can change really quickly. I mean, we're in this period now where there's clearly a concern about the currency, and there's clearly a concern about how do we bring the debt down, how do we get interest rates down. So I'd say near term, there is a question. Listen, I think reserve currency status is something that is absolutely critical to the United States. We fund a lot of debt globally. The number of, the percentage of trades in the world that happen in dollars, bills as a collateral for many of the transactions in the world. I think reserve currency status is absolutely critical. Are you denting it? You're definitely denting it. But listen, I think this year is going to change. I think we've got a couple of months here where there's a lot of uncertainty. You got an economy that's probably in recession today in terms of certainly where corporate spend will be. But I think as you get into the back half of the year, things can really evolve. So listen, I think you're chipping away at reserve currency, but I don't think there's a natural alternative. So, I think things can change. Hopefully they do.
Rick, hopefully they do. But that last point there I think is important. If we are in recession today, do you think risk assets are appropriately priced for that scenario?
So I would say today, listen, I think the tail has gotten fatter. I think quality assets, they're pretty reasonable. There's a lot of quality assets we've been added to agency mortgages, et cetera. Listen, I think you've got to put a wider range on the equity market today than you've had before. You've got an economy that's pretty uncertain. And you've got to, I think you got to keep your beta a bit more restrained today. Quite frankly, one of the most interesting trades in the last couple of weeks has been to sell puts, not to necessarily increase, but, the best time to sell insurance is after a hurricane. And there've been some great trades actually sell downside where, gosh, if we go down another 10, 15, 20, depending on single name, go down 10, 15, 20%, you get paid handsomely for taking that. So keep your beta restrained, hunker down a bit in terms of risk, but then find some place like, gosh, I would add if we came down, if markets went down significantly. So anyway, there are a bunch of things to do in this market, but I just think you have to expand your where you think your return objectives are going to be and the probability around it in an environment like this.
Things have changed a lot. Rick, it's good to see you, as always. Rick Reeder of BlackRock there. Rick, thank you, sir. We'll do it again soon. Equity futures on the S&P negative here by 0.8%. Let's get you an update on stories elsewhere with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. China says it's open to trade talks with the U.S., but only after President Trump meets its requirements, like reining in remarks from his cabinet members. Sources tell us that other conditions include a more consistent U.S. position and a willingness to address China's concerns around sanctions and Taiwan. The White House is banning NVIDIA from selling its H20 chips in China, a clear sign that the administration will stay on the course on limiting China's AI ambitions. The restrictions will require a license to export the chips for the indefinite future. NVIDIA warns it will likely report a $5.5 billion write-down tied to inventory and commitments. Elsewhere, the White House is open to probe into the need for tariffs on critical minerals, citing national security and resilience concerns. The order covers a range of minerals, including rare earth elements and uranium, and could lead to tariffs on imports from countries like China, which currently supply 70% of U.S. rare earth imports. And that's your brief. John.
Hey, Danny, thank you. More from Danny later this hour. Later this hour, U.S. retail sales. That drops at 8:30 Eastern Time. Up next, the morning calls, plus the United Airlines CEO, Scott Kirby, on the airline's dual forecast. That's next. This is Bloomberg.
Politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This hour is all about the U.S. consumer. Consumer sentiment, according to the University of Michigan survey put out on Friday, close to a 3-year low. Inflation expectations, multi-decade highs, and anxiety about unemployment at levels we haven't seen since 2009. That's how people feel. What are they doing? Retail sales, 15 minutes away. Equity futures on the S&P negative by 0.75%. On the Nasdaq, we're down by 1.4%. On the Russell, we're a little bit lighter, only down by about 0.25%. Let's get you some morning calls. First up, Piper Sandler lowering its price target on NVIDIA to 150, citing new export restrictions from the Trump administration. Your second call from Goldman, downgrading target to neutral. The analyst saying tariffs and the inflation outlook are taking a toll on consumer sentiment. And Target right now is down by about 1.2%. And your third and final call from Morgan Stanley, reiterating its overweight on United Airlines, expecting forward guidance to reinforce U.S. airline optimism. The stock is up by 6% in early trading. Let's stick with United. The airline reporting its best first quarter performance in 5 years and offering investors dual forecasts in the face of economic uncertainty, writing in a statement, the company's outlook is dependent on the macro environment, which the company believes is impossible to predict this year. with any degree of confidence. Joining us now, the main man, the United Airlines CEO, Scott Kirby. Scott, welcome back to the program, sir. It's good to catch up with you once again. Let me just understand maybe your approach to this earnings report, how you and the team decided, you know what, this time I think we have to do something different and offer a dual forecast. Where did that come from, Scott?
Yeah, we did. We thought it was appropriate to do something different. It starts with, you know, the environment has gotten more difficult. But first, you know, we did have, you know, as you said in the intro, the best margins we had in 5 years. We grew margins year over year. One of only 2 airlines that are profitable. And as we kind of went through it, we still see a viable path to getting to our, as long as bookings remain stable as they are today, to getting to our original guidance. But we also recognize that there's more macroeconomic uncertainty, that people are fearful of a recession. It hasn't happened yet, but that they're fearful of a recession. And so we wanted to also give investors some outlook on what we think a recession could look like if it happens here at United. So really the goal was to just give investors more information. It's non-traditional. We're the first ones that I ever know of that have done something like this. And so far the feedback has been really positive. And I think investors and others appreciate that we try to give them a more fulsome range as we gave guidance this time.
Scott, can you give us a sense if you were catering more to investor nervousness or whether you were responding to actual weakness that you see in some of the forward bookings by clients?
So I'm guessing you're referring to our capacity changes. And, you know, we're going to pull about 4 points of capacity from the second half of this year. That's really just a pure tactical economic decision. We do see weakness, and because we see weakness, it means we're starting to cancel some of the utilization flying. That red-eye flight that was barely profitable in really peak strong times becomes unprofitable when the demand environment weakens a little bit. Customers have more choice to fly at better times a day, and so they do. And so all we're really doing tactically is pulling some of that marginal flying, marginal in good times turns negative in bad times. So we're just pulling that out of the system.
How much do you see going forward, though, any kind of retrenchment from consumers whatsoever? A lot of people have been talking about how particularly international travel is going to come down with people from overseas not coming to the U.S. Are you seeing that in forward bookings, or has that kind of been more of a narrative than a reality?
It's been more of a narrative than a reality. We saw weakness starting kind of at the end of January. We saw a step down, but it has stabilized in March, and even the first 2 weeks of April, it has stabilized. And the weakest area we see is actually the low-end domestic consumer here in the United States. International has remained quite strong. International, for what it's worth, is 82% U.S. point of sale. So it's much more dependent on the U.S. economy than foreigners coming to the United States. It's also less corporate than it used to be. And because of that, you know, the leisure traveler is still going. The premium leisure is still there. Typically, even in times of economic weakness, the high-end consumer outperforms. And that's what we thought would happen. That's what we've seen so far. We'll keep watching it, of course, but that's certainly what we've seen so far.
How much does this really put you in a position to consolidate market share? Right now, we keep seeing that among a lot of the leaders in different industries, that this is time for them to compete on price, to compete on some of the offerings, and frankly, squeeze some of the other weaker players in the market so that you emerge on the other side a lot stronger. Do you see that happening with United right now?
Well, United, we've had a 5-year strategy to win brand loyal customers, and we've done that. So really nothing is changing now. We're not doing anything incremental, anything different. We're continuing the path that we have been on because it's worked. It's led to the best margins in good times. I think that lead is going to expand in tough times, not because we're doing anything special, but just because we'll have more seats to sell available to those customers. And when you're the brand loyal airline, when times get tough and you have more seats to sell, more customers migrate to you. And so we'll wind up selling more seats at lower prices because that's the way our yield management system works. But we'll sell just as many seats, but it's going to make it much harder at the bottom of the customer choice pyramid.
Scott, as you know, there's a lot of tension right now between the United States and China. That's been expressed in several rounds of tariffs from either side. We hope they can come to the table and have some talks, but so far, not great. For the maintenance of your planes, sir, and the exposure that you have to China, to Hong Kong, how are you managing that situation at the moment?
So at United, we have more of our heavy maintenance work done here in the United States than any airline in the country. We've been growing here in the U.S. In fact, over a 3-year period, we're going to hire about 5,000 maintenance technicians here in the United States, building huge new facilities in Houston and in Orlando, and most of our work is done in the free trade zone outside of Hong Kong, the work that is done in China. So we're monitoring it day by day, but we have a high percentage here in the United States, more than anyone else, and feel good about our setup.
Scott, some CEOs have been quite outspoken about what they'd like to see from the administration on policy. Are you willing to do that? Is there a reason why maybe you'd be a little bit more hesitant to weigh in?
Well, I've spent a lot of time in D.C. This year, as I always do, but I've mostly been focused on listening instead of talking. And so I wanted to understand where the administration was coming from, what their goals were, how they were trying to get there. And I actually by the end of March, felt like I had a pretty good understanding of that. And if you have that kind of understanding and you can put everything that's happening into context, it makes it a lot easier to manage the business, to not make panicky decisions. And what I think is happening here is, we're nowhere near the end game yet. These are still the opening moves of the chess game. And I think I and most people that I talk to, or things have slowed down, but we're all in a kind of a take a breath mode. And let's wait till we get to whatever the new normal is going to be before we start making big long-term decisions.
We've all got to take a deep breath. Your stock is up this morning by about 6.5%. I wanted to talk about something with you that we've been talking about for a while on this program. Scott, as you know, one of the most disruptive parts of flying right now is the boarding process. And when you get on, everyone is wrestling to find space to put their bag over their seat. How do we address that situation, Scott? Because I could tell you as a traveler, it is the most annoying experience, and it's not unique to United. It's something we're seeing across the board.
As a father of 7, I understand it, trying to get on with a bunch of kids. And I'd say we're fixing that at United. The biggest thing we can do, we had to put bigger bins on the airplanes. We're over 50% through the fleet at United, but we're putting bins on all the airplanes that are large enough that on a 100% full airplane, every single customer can bring a rollerboard on and put it in the overhead. And I think that, at its core, is how we're going to solve it.
Scott, how much more can you get people to pay for things that they used to know they could get? I know that Frontier used to do that with cans of soda, and then they had to backtrack, or checking bags. Are there other things that you can monetize, or does it really come down to the credit card business, the loyalty program, counting on the front of the cabin?
At United, actually, we're kind of going the opposite direction. We have disaggregated the product. Give customers what they want. If you want the premium product, you can get it. You can go the regular economy product all the way down to basic economy. But, we got Starlink coming next year. We're going to have the fastest Wi-Fi in the sky, and that's going to be free for our customers. So Wi-Fi is going to be free, and it's going to be by far the best experience, the most bandwidth, the fastest speeds for any customers. And, in a lot of ways, increasingly, instead of being an airline that also has a loyalty business, we are becoming a loyalty business that runs an airline. I mean, being able to get customers to Tahiti and Cape Town, that's the cool, sexy reward that you get in the loyalty program. But, the large airlines, particularly like United, we really have the best, the deepest loyalty program. When I talked earlier about brand loyal customers, like customers that want to fly United Airlines. And that is the strength. That's what's given us the resilience to have strong earnings, even in a tough macro environment. It's what's going to let us outperform, even if the economy gets weaker from here. That loyalty of customers, whether you call it the loyalty business or just having brand loyal customers, is the foundation that's letting United outperform.
A masterclass in communications from the firm in the last 24 hours. Scott, appreciate your time. Thank you. Scott Kirby there, the United Airlines CEO. Up next on the program, U.S. retail sales. We know how the consumer feels. How are they spending? We'll talk about that next on the program. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures on the S&P 500 negative here by 0.75%. Retail sales just seconds away with the Nasdaq down by 1.4. In the bond market, your 2-year, 10-year and 30-year look like this. Your 10-year yield just about unchanged at 432. Your 2-year at 380.93. The spread between the soft data and the hard data is incredibly wide. Survey data, consumer confidence, rock bottom. What do retail sales look like? Here's Mike McKee. Good morning, Mike.
Good morning, John. They look pretty good. They look exactly as economists had forecast, coming in up 1.4% for the month of March. We got to check the revisions to February. Ex-autos, though, up a little bit more than thought, 0.5%, but it does show that a lot of the spending was on cars, people getting ahead of the Trump tax increase with that. The control group, the important one that goes into GDP, up 0.4 on the month. That is down from 1.3%, revised up for February. So all in all, better news for the retail sales control group than it would appear. And we don't have a revision, it appears, to the advance headline number, 0.2% in February. So 1.4% and 0.4% on a 1.3% revision. So is the control group, and that's the baseline numbers. Shows people were pulling ahead purchases ahead of the Trump tax moves.
So, Mike, you don't think this points to strength as we approach the April data, which is going to become more important to see how this effect from tariffs starts to bite into the economy?
I don't think we can say that at this point. Now, I need to take a look at what the breakdown is, but the expectation was people would act to get ahead of the tariffs. We saw it on the business side with lots of imports of business industrial materials, and now we did see a big change in terms of overall purchases for consumers, and it does look like a lot of that came from cars. Now, the March advance in motor vehicles was 5.3%, so a very strong motor vehicle sales month, it appears. Building materials up 3.3%. Food and beverage stores kind of a light 0.2%, but gasoline stations were down 2.5%. So you can see the impact that the car sales had. They overcame the fall in gasoline prices. General merchandise stores up 0.6%, and of course we always want to know what happens to non-store retailers. They didn't have a great month, up just 0.1%. Food services and drinking places, we all went out and celebrated before the taxes went up on imports, 1.8%. So this doesn't suggest that we've got uniform strength throughout the various categories, but it does suggest people were spending money in March after spending money in February. The question is, do they keep that up now in April?
Or maybe we were just celebrating Liberation Day, Mike. We'll let you go. Mike McKee, Thank you, sir. Not sure Mike was. Equity futures on the S&P, negative by 0.8%. On the Nasdaq, we're down by 1.45. In the bond market, 2-year, 10-year, 30-year yields just about lower by a single basis point on a 10-year to 432. Down by 381 on twos. Lisa, we've heard this conversation before. The pull forward in anticipation of tariffs in April. It was always going to shape that March data in a certain way.
It was. It's hard, though, to really reconcile that with the upside revisions that we saw for February. It's not just March data coming in stronger than expected, at least when you look at retail sales, ex-auto and gas. It's also that it was revised up to 0.8% for February from 0.5% initially. You see the same when you look at ex-auto. So there is something else going on in terms of ongoing strength that becomes that much more difficult to know how to read some of the soft data, which, again, is not cohering with what we're seeing in this hard data.
Let's get into this subject with Tiffany Wilding of PIMCO. Tiffany joins us now from the West Coast. Tiffany, welcome to the program, and thanks for waking up so early for us as well over in Newport Beach. Let's talk about this data, retail sales. Tiffany, we know that consumer confidence is rock bottom, and we know it was rock bottom going into that April 2nd tariff announcement. How wide is the gap between what people are saying about how they feel and what you're seeing on the ground happening in the economy?
Yeah, well, I mean, I think the conversation that you were having about pulling forward purchases ahead of tariffs, I definitely think that is boosting demand for goods and retail sales in particular. And I think it was a longer story than just March or February. You know, even though we got many of the we started getting more of the tariff-related announcements in March. Obviously, the big ones were in April. When we look at the data, we see above-trend purchases in goods that really started late last year, in the second half of last year. And so we think actually consumers have been doing this for quite some time. If you look at the sentiment surveys, you also saw inflation expectations that started to rise late last year as a result of tariffs. So we do think that it's going on. Any given month can be noisy, but basically what that suggests is if you're getting a pull forward of purchases here, you know, regardless of what happens in actual tariff policy, you know, if tariffs weren't actually implemented, you know, you should see some softness afterward just because, you know, consumers had all this pull forward activity.
Tiffany, there's a larger question here about how much we can rely on hard data, given that the soft data, or how much we can rely on soft data, excuse me, when the hard data really isn't confirming the negativity that we're seeing in that soft data. Can you just step back and, as an economist, speak about how much you can rely on the narrowing of the gap between these two metrics, these two inputs?
Well, I mean, I think that, you know, you have to start to see the actual price increases, which we have. There's been many more of these tariff surcharges. Consumers are actually starting to feel the tariff impact now as we're speaking. So I think you could see much more of this, you know, in the data ahead. You know, March was just kind of the precursor to all of the April news. And then I think the other big thing that we all need to watch is just the imports data. The amount and the level of tariffs that we have on China, for example, you know, should over some time, if that is not reduced, basically leave our, reduce our imports from China to basically zero at some point. And so how quickly we see that happen will give us a sense for the disruption in the U.S. economy that's going to happen. You know, obviously looking at the price data will be very helpful, but I think until consumers start to see that, they won't, you know, they're not exactly changing their behaviors yet. They're trying to pull forward some purchases, but you know the weakness will come, you know, once we see the other actual effects.
So Tiffany, is it fair to say that what we're seeing right now in the March retail sales isn't incorporating some of the policy shifts that have really affected sentiment?
Yeah, I mean, we certainly haven't seen, we didn't see any evidence in the, we haven't seen any evidence in the inflation data, you know, that you're getting massive increases in prices. You know, I would say if you squint, you know, maybe in some certain categories like appliances and things like that, you've seen the auto dealers basically say that we're not going to raise prices until we get through the current inventory. So it absolutely makes sense that people are hurrying up to the auto lots to buy the cars at these lower prices right now. You know, so I think you're just not, you know, we are in the early stages of this. I think the April, May, you know, over the summer, Once all of this really starts to sink in, you start to have stockouts of certain goods and things like that. That's when you're going to see more of a reaction from consumers, I think.
Tiffany, at the moment we're seeing good hard data. You have negotiations taking place even today with the White House and trading partners. What does the Fed do with all of this, especially as we have Jay Powell speaking later?
Yeah, I mean, I think this puts the Fed in an incredibly hard position. I think, obviously you have this outlook for inflation to accelerate, and that's shown up in inflation expectations. I know the Fed has dismissed the increase across most major surveys in inflation expectations, including the U of Michigan report, which has a longer-term measure. They've sort of downplayed that or dismissed it. The survey of professional forecasters from the Philly Fed is a key measure that they will be looking at. We will get that in May ahead of that FOMC meeting. And I think if you start to see that longer-term inflation expectation measure accelerate, then that can be a bigger problem for the Fed. And we've said we think it constrains them. And when we say constrains them, what we mean is that we think they really need to see the labor market, really cracking here. Unemployment, accelerating job growth that's turning negative for them to respond. That 2018, 2019 type of response that was more preemptive, they expected weakness, so they cut ahead of that. You're not going to be able to see that from them this time. So it's going to be more delayed, but that means once they do start cutting, they do start to see that weakness, that you could see, a much more swift response, although more delayed.
Tiffany, is there a metric you have in mind? Unemployment at the moment is at 4.2. Is there a number that you think would trigger that moment for them?
Yeah, I mean, I think, and I think the speed here is key. If you're seeing unemployment that's accelerating up to 4.5 or above pretty quickly, within the context of a few months, at the same time, you're seeing, retail sales and consumer spending collapse. You're seeing imports collapse. All of those things, I think, would contribute to them cutting rates. I think in terms of the data flow and when their meetings are, I think May is probably too soon. Like we've been talking about, the actual brunt of all of this, is likely going to be seen in the data. In the early summer to even midsummer. So I think June and maybe even the May and maybe even the June meeting is too early to really start to see the labor market effects. We think it might be September before they could really get a good read on all of this.
Interesting. Tiffany, appreciate the input. Thank you. Tiffany Welding there of PIMCO. Tiffany going through it there for the Federal Reserve that unlike last year where they could act preemptively, the first time of any kind of crack, the first sign of any cracks whatsoever in the labor market, they moved aggressively 100 basis points. So this time around, it's basically a commitment to being late. If you're waiting until September, you're waiting for unemployment to go north of 4.5%. A lot of people would say you're already late.
Right, which again goes to this question of how much can they signal? Considering that the market will get out in front of them. They want rates to give some sort of downward pressure to inflation when it is coming up and inflation expectations over the long term. As I was listening to Tiffany there, I was thinking, okay, so they're going to cut a full percentage point in September? Seriously, I mean, if it really does weaken, at what point are they ready to step in with some really serious
The
firepower?
good news for Chairman Powell later on this afternoon is that we don't see that weakness yet. Seeing the survey data, sure, we've seen it in the markets and they've taken note of that, but we don't see it in the retail sales number we just got 10 minutes ago.
The good news for him is that expectations are very low and that really people are not looking for any signal from him, and they understand that it is a black box that he is in with a blindfold, and that his job is to be a politician and to be something of a messenger of calm, steady, and not overreacting in any which way.
You'll get some version of that at 1:30 this afternoon, so look out for that. Katie Kaminsky of Alpha Simplex joins us now for more. Katie, welcome to the program. We caught up with Rick Reeder of BlackRock earlier on this hour. I wouldn't call him a bear. He was more constructive in the long term, but short term he was cautious. He was talking about a gold position, building up cash. He was talking about being in a recession as we speak. Katie, what's your approach to this moment?
So this is a good question, because right now what we're seeing is that technical signals have really sort of stepped away. There's very little direction in the market at this point in terms of what we're seeing in our signals for both bonds and stocks. This concerns me because it really doesn't seem like there's any sort of catalyst that is going to change that narrative very easily soon, just given the complexities of negotiations in this particular trade war. I'll say there's a few exceptions, and that's why this is an interesting point. with retail sales today. Commodities have been interesting, especially energies, and you've seen some other exceptions there, like soybeans, that have really rallied as a function of the trade war impact. So gold, metals, energies, agriculturals are places to kind of look around right now that things are moving.
Before we dig into commodities, Katie, I am curious your view on trend-following strategies at a time like this of incredible policy uncertainty. Do they kind of lose their relevance, at least in the short term, because there really isn't a trend to follow other than maybe a truth post?
This is a very good question, and we actually wrote an article this week about it, about crisis or correction. And the reason that we examined how trend following does during different drawdown periods for equities is that those initial drawdowns, when there's a shock, often do create a dispergence of trends that are actually quite hard to follow. And it's usually the aftermath of changes in macro policy that provide more opportunities. So I think the way that we're thinking about it is, what are the long-term trends that will occur as a function of us realizing the impact of this policy? But yes, you're correct. Any sort of short-term shock is very difficult for a lot of systematic strategies and other strategies that are following sort of prevailing themes going into a massive shift.
I don't mean to put you on the spot, Katie, but there is some speculation out there that some of these trend following and systematic type strategies are behind some of the volatility or have actually exacerbated it with leverage unwinding and positions that get stopped out and a lot of trends that completely got reversed in just a matter of hours or minutes. Do you believe that? Do you think that that actually has been a contributor to the incredible volatility that we've seen?
Well, I'd say, I think it's hard to say that just one particular strategy is driving all the volatility. What we have seen is that across the board, de-risking occurred. And that occurred not just in systematic strategies, but in long-only investors and retail investors. So I do think that, the de-risking that does occur when there's a shock is something that people have to think about. And it's something that, when we look at trend, for example, it's actually something that is measured and controlled, whereas in certain strategies, it could be much more aggressive.
Katie, Rick Reeder said what we could see maybe is a dent with the US dollar in terms of a global reserve currency. Do you buy that?
We're actually seeing a little bit of that right now, and I think that's something that's interesting. Let's just take a little step back at what we've just seen. First of all, we had equities take massive losses, but at the same time, the dollar has not been stronger. So if you're actually trying to improve your trade balance, it should be pro-dollar. It means that you're actually seeing potential weakness of U.S. assets. And you've seen that in the Treasury market as well. Look at both Treasuries and the dollar. They both got hit by sort of this risk-off move related to post-Liberation Day. And that, to me, is a suggestion that the appetite for U.S. assets could be something that is a question, making both the dollar and U.S. Treasuries more vulnerable going forward as you try to navigate this new policy.
More than 2/3 of transactions, though, in the world come and stem from, or at least on the margins, hit the dollar. Who fills that void?
That's a good question. I mean, I think as that starts to shift, we have seen things like the yen, the euro, other sort of currencies rally in response to this type of move. It may just be sort of a preliminary thought question about sort of what happens if the dollar loses some of its strength, where do we go? But right now, the data is showing that, the yen was the beneficiary of this, and so the euro. And I think that narrative will change as we learn more about how much of an impact this policy has.
Things can change quickly, that's for sure. Katie, appreciate the update from you. Katie Kaminsky there of Alpha Simplex. You can get wrapped up in the emotion and the drama down in Washington, D.C., or just attempt to call balls and strikes. Just now, looking at where things are, corporate America's doing okay. If you look at the earnings we've had from Wall Street, from United Airlines, things are better than we anticipated only a number of weeks ago. And I would say the same applies to trade too. April 2nd, they were talking about going big, large, aggressive, a huge global realignment. In the last week alone, I'm hearing more about negotiations and exemptions. That is a very different position compared to where we were only a few weeks ago.
And there's actually a connection between these two. If you take a look at some of the polls coming out of CBS and YouGov, as well as a whole host of others, what you see is, yes, a majority of Americans are concerned about the potential of increase in tariffs and inflation, but they do think it's a negotiation. And they do think that there does need to be change. I mean, there is a difference between some of the taking things to the worst case scenario versus what people are actually doing and how they're taking it in terms of the messaging at home.
This is an ongoing process. We'll continue to follow all the news as it comes in. On the S&P 500, we're down by about 0.9%. The earnings report of the season, though, I have to say, I think is going to be Apple. 1st of May. That's got to be the big one, right?
What kind of range are they going to give? Potentially 0 or potentially,
a bull case, a bear case, a base case?
Yeah, I mean, they're going to be in a particular tricky situation because they're going to have to also be messaging their earnings to a specific person. So a lot of what we're hearing right now is also messaging as people say, look, we're with you, we got you, we're going to give you what you want, please give us what we want.
You're not talking about investor relations, are you?
Well,
you're talking about White House relations.
100%, and when you hear it across the board, people are speaking directly to one person again and again.
Tech earnings a few weeks away. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March U.S. retail sales came in line with estimates with a headline number of 1.4%. It's the biggest increase in more than 2 years, driven by a jump in car purchases, suggesting that consumers are scrambling to get ahead of auto tariffs. Elsewhere, President Trump said that he will attend a meeting with Japan to discuss tariffs, military support, and trade fairness today. In a post on Truth Social, Trump said U.S. Treasury and Commerce secretaries will also be in attendance. Japan is one of the first countries to negotiate the levies. Lyft is expanding into Europe. The company has announced it's buying Free Now for about $197 million from BMW and Mercedes-Benz. The taxi-focused mobility platform operates in over 150 cities in 9 countries across Europe. The transaction is expected to close in the second half of this year. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. One big event still to come. Chairman Powell later on this afternoon. We'll get you a preview with Mike McKee in just a moment. From New York, this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Can you believe it's 2 weeks since Liberation Day, April 2nd? 2 weeks. Total blur. Equity futures right now in the S&P, negative by 0.9%, and it feels like nothing. Why? Because a week ago, last Wednesday, this market was down 3%, then rallied 10. A 13 percentage point intraday swing on equity futures. This is calm relative to the previous week. Coming up this week, here's your trading diary. President Trump saying he'll meet with Japanese trade representatives today, so look out for that. 1:30 Eastern Time. Remarks from Fed Chair Jay Powell. Tomorrow, an ECB rate decision, plus another round of jobless claims, and we'll get Netflix earnings. Friday, of course, remember, markets closed for the Good Friday holiday. Joining us now, Mike McKee with a preview of what to expect at 1:30 Eastern Time. Mike, what are you and the team looking for?
Well, we're looking to see if there's any way Jay Powell can reframe the argument that the Fed has made so far, and that is that they don't know what's going on, so they're going to have to be flexible on both ends. For the past week, the chair and all of the other Fed members who've spoken have said the same thing, that if unemployment goes up, the economy weakens, they can cut rates. If inflation goes up, they can raise rates, but since they don't know what's going on, they're in a good position to just kind of sit where they are. That's what we're hearing from CEOs as well, including Scott Kirby, who was on with you from United Airlines this morning. They've put out a forecast. If the economy weakens and people stop flying, that will be bad for our business. But if the import tariff taxes aren't so bad, then maybe people continue to fly and we can get through it. Nobody really knows at this point. I think Tiffany Wilding differently or reassure Wall Street? That'll be the question of the day.
We're going to find out in a few hours' time. Looking forward to your coverage, Mike, as always. Mike McKee there over in Chicago. Chairman Powell addressing the Economic Club of Chicago at 1:30 Eastern Time.
Yeah, honestly, to me, it's going to be very unclear why he has any incentive whatsoever to come out with some sort of bold statement. Why not just say as little as he possibly can and say that we're watching everything closely and we can respond if we see something that warrants it. But otherwise, we're in a great place, so thank you for coming.
You're making me think I don't need to tune in for that, which makes me think I can tune in for something more important, something Jay Powell's looking probably to try to get data from to understand where the economy is going. And that is the fact that the President of the United States is joining these negotiations. This, I can't really explain how unusual this is, that the president goes in with the negotiating teams. He's supposed to be the last person to see a deal before it's signed off on, not to be there in the middle negotiating, but wants to take a front row seat and a real hands-on approach.
I think it's fair to say they are, for communication purposes maybe, a little bit later on this afternoon.
Roll out the red carpet. Look what happens when you come.
First come, first served.
You know, guess what? We're going to give you tea. We're going to get you really nice cookies. And you know what? The president's going to be there too.
And you get Secretary Besson as well. Yeah. And if you come late, who do you get instead?
Just straight Navarro.
Exactly. This is how it works. Good cop, bad cop. Futures right now down by 0.9%. Coming up tomorrow, Jean Barvan of BlackRock, former senior Trump trade advisor Kellyanne Shaw, Vishal Kanduja of Morgan Stanley, and Mohammed Al-Erin of Queen's College, Cambridge, joining us on set tomorrow in the studio. Look out for that. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good Wednesday morning, 30 minutes until the start of the cash trade with futures down. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, China says it's open to trade talks with the U.S., but only if Washington shows more respect.
Chip makers caught in the crossfire. NVIDIA faces an export crackdown as ASML issues a disappointing report.
Meanwhile, United shares taking off in the pre-market as the airline games out two possible earnings scenarios. Shares, if we show them, are up about 5% or so right now. But let's get to one of our big stories, and that, of course, is NVIDIA, saying that the U.S. has banned sales of its H20 chip in China. That's a move that the company warns could cost more than $5 billion this quarter. Shares down almost 7%, Matt Miller.
And as I said, the Dutch chip maker ASML orders were almost €1 billion less than had been expected. ASML says it doesn't know how to quantify the impact from recent tariff announcements.
And I'm going to get you guys that United Airlines action. We're looking at it up about 6%, as Katie was talking about. They also are uncertain about how the trade war will impact its business. They've provided two possible forecasts in case of a U.S. recession, Katie.
Meanwhile, there are signs of progress with tariff talks. China says it's open to negotiations with the U.S. on certain conditions. Meanwhile, the president gave a statement through Press Secretary Caroline Leavitt yesterday afternoon.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
Bloomberg's Tyler Kendall joins us now from Washington, D.C. with the latest on U.S.-China relations. Sounds a little bit frosty. Tyler, what's happening sort of under the surface?
Yeah, hey, Matt. Well, after weeks of escalation, this really is sort of the first insights that we've gotten into potentially what could help to bring down the temperature, even as we still see some pretty tough rhetoric from both sides. Now, a person familiar with the Chinese government's thinking does tell Bloomberg News that the most important precondition for any sort of trade talks is that Chinese officials feel that they will be treated with respect. It appears that Beijing would like to see President Trump start to disavow comments from his cabinet members when they are critical of China
China, even as President Trump himself says that he has a positive relationship with the Xi Jinping. We are also learning, importantly, that it appears that Beijing would like to see the U.S. appoint a point person that can speak and act in President Trump's capacity during these talks. But as you well know, the White House says that President Trump will be involved directly with all negotiations, and he himself says that he's waiting for Xi's call. We have to keep in mind here, just this morning, President Trump announcing that he is going to be involved directly when it comes to negotiations with Japan, that he will be in that meeting alongside his Commerce Secretary Howard Lutnick and also his Treasury Secretary Scott Bessent. And really, in the past, we should note that some direct calls to this White House have actually yielded more expedited negotiations, such as in the case of Japan, but also South Korea and Vietnam, as Xi Jinping himself goes on a tour of Southeast Asia and meets directly with other leaders in his bid to shore up support. Matt, Bloomberg Economics estimates that once these trade talks do restart in earnest, they will likely take months and probably into 2026.
Well, Tyler, you mentioned two of what seem to be the big points here. First of all, respect. We know that Vice President J.D. Vance referred to Chinese peasants in a Fox News interview a couple of weeks ago. But I want to talk about a point person here to really be leading the negotiations from the U.S. side. As you mentioned, President Trump will likely be involved in a lot of these discussions, or at least that's the position that the White House has taken. But talk us through the Chinese side of things to have basically delegates rather than these two leaders talking directly.
Right, and actually, Katie, we've already sort of seen this start earlier in the year. Of course, there were negotiations back in February when the U.S. implemented its first baseline 20% tariff on China over fentanyl concerns. But then it appears that those talks broke down, and now the gap is even bigger. But for example, we had seen Republican Senator Steve Daines go over to Beijing, and that was seen as an important first step, as a precursor now about a month ago, to try to set the table for a potential summit between Xi and President Trump. It does appear, though, that that China would like somebody else other than President Trump to lead the negotiations. We know that Treasury Secretary Scott Bessent, as one example, is taking on more of a formal role here going forward when it comes to exactly what we are starting to see come out of these negotiations. The press secretary yesterday, we heard her before, she said that so far there are at least 15 more concrete offers on the table, not when it comes to China, but these other countries. Scott Bessent telling Anne-Marie earlier this week that why China is particularly tricky to negotiate with is because they are an economic competitor, but also a military rival.
Bloomberg's Tyler Kendall in Washington. We appreciate all of your reporting. And we had mentioned a little earlier that the U.S. is barring NVIDIA from selling its H20 chip to China, which could lead to a $5 billion write-down this quarter. Bloomberg Technology co-host Ed Ladlow has more. A note from UBS this morning as well estimates $13 billion, another number for you, $13 billion in revenue could be impacted by the ban, but the idea that that could be covered elsewhere. Dan Ives, let's take a quick listen to what he had to say. He talked about a broader strategic blow. He said the financial impact is small relatively, but the strategic blow is the focus of the market, as NVIDIA now has massive blockades going after the China market in the middle of this raging U.S.-China tariff battle. What do you say, Ed?
For many weeks, the technology industry has been warning me that we are very focused on tariffs and forget that it is a two-pincer policy move. Tariffs and technology export controls. And what we know from the reporting is that the Biden administration itself had considered cracking down on the H20. The H20 is an AI accelerator, a chip that's particularly good at the inference stage, but it exists because NVIDIA made it in 2023 in response to existing technology export controls. What the government is saying now is we don't want you to sell the H20 because we're worried it will end up in a Chinese supercomputer. Mechanically, it's a $5.5 billion write-down in the period ending April 27th. But here's the umbrella point. NVIDIA wants to sell into China. In 2022, China revenues for NVIDIA were about 26%. It was at that time a critical cloud computing market. Fast forward to present day, and it's increasingly moving towards low single digits. And so I think that number is interesting. Our own Bloomberg Intelligence number is that at the high end, it will result in a loss of revenues of about 18 billion this year. But NVIDIA is supply constrained. What it can't sell in China, someone somewhere else will happily take.
What does this mean, Ed, for other chip makers than NVIDIA? Let's not forget that NVIDIA is not the only one.
Correct. It has a monopoly, more than 70% market share, is dominant, but AMD is the next one to ask about. It has its own specialized chip, MI308, exactly the same thing. Lower performance, lower specification, but technically can be used in the inference phase when we talk about AI. Will that be subject to the same license requirement? We don't know. We will get the opportunity to ask, thankfully. But that is interesting. And again, you know, this is the point that, like, more than 50% of all the research that goes into AI is done out of China or by Chinese citizens who are in that field. And so it's very complicated, right? You want to onshore American manufacturing of high-performance GPUs for AI. You want to protect the leadership of American AI. But there's a big center of activity and demand coming from China. And this is separate from tariffs, right? This is about restrictions on the export of technology.
All right, Ed Ludlow with the latest on NVIDIA and all the other chip makers. And Ed will be talking to the White House Director of the Office of Science and Technology Policy on this topic today at 11:30 a.m. New York time. That's on Bloomberg Technology, but keep it here because we're also going to be talking about the White House investigating the need for tariffs on critical minerals, citing national security and resilience concerns. Bloomberg's Joe Doe covers metals. He joins us now. So we're getting very familiar with Section 232 investigations here. Set the scene for us. What do we define as critical?
It's pretty simple. Critical minerals in the eyes of the United States government is a list determined by the U.S. Geological Survey. That's it. So there's 50 of them. The U.S. Geological Survey typically works in tandem with the DoD and the DOE to determine which minerals elements are critical to national security. In other words, the United States doesn't have readily available deposits in the ground or stockpiles that in the event of an all-out war, it would be sufficient enough to sustain itself over the course of a certain amount of time.
So let's take this from a different perspective, not just from a national security perspective, but from a business perspective.
Yeah, let's do it.
Because sustaining yourself would also mean being able to run the economy, doesn't it?
Yeah, I mean, listen, I have spoken to former DoD officials who put this very well to me. If the DoD is your only customer, that's not a good situation for any market whatsoever. The DoD, since the post-World War II era, has effectively said, we work in tandem with a robust market in order to supply the things that we need most. There's no other way to put it, right? Like, just because you need it doesn't mean, well, it's only going to be the DoD that sustains whatever it is, yttrium purchases or 10 purchases. I mean, we don't, like aluminum, for example, is considered a critical mineral in the eyes of the United States government. Well, we have a robust aluminum industry.
All right, fascinating stuff, and I'm sure we're going to continue to hear more about what critical minerals are and learn more about what Section 232 means. Bloomberg's Joe Doe talking to us about that. Let's get a check on what's going on in the markets.
Yeah, this is what happens when you have NVIDIA shares down nearly 7% pre-market. You take a look at what that translates to for the S&P 500, down nearly 1% right now, a little bit more than that. The real pain is being expressed in the NASDAQ 100, as you might expect, down about 1.8% or so. Those good vibes we were feeling at the end of last week fading right now. The Russell 2000 also selling off those small caps. Coming up, United, though, offering dual forecasts while warning of recession risk. We'll take a look at the airliner next, currently up about 6%. This is Open Interest.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Let's get to high interest, to look at what's making headlines around the world. California Governor Gavin Newsom said his state is suing to halt President Trump's tariffs, citing harm to consumers and businesses in the world's fifth largest economy. The state will file a complaint today in San Francisco federal court challenging Trump's use of emergency powers to enact broad tariffs against Mexico, China, and Canada. Newsom is a Democrat who's considered a likely candidate to run for president in 2028. Abbott Laboratories said it will build 2 new U.S. manufacturing plants as tariffs on medical devices loom over the industry. Abbott expects to spend $500 million to expand its plants in Illinois and Texas. While pharmaceutical products were exempt from tariffs announced earlier this month, medical devices are still subject to the levies that have been partially paused for 90 days. And Hertz shares are soaring pre-market after Pershing Square revealed a large stake in the struggling car rental company. Bill Ackman's firm bought 12.7 million shares valued at $46.5 million. Hertz has been working on revamping its fleet after an ill-advised bet on Tesla EVs, which were unpopular with customers and expensive to maintain. Hertz emerged from bankruptcy in 2021. Sonali?
And United Airlines is taking an unusual step, providing 2 possible earnings scenarios. It's another indication of how tariff uncertainty is weighing on company forecasts. The company's CEO, Scott Kirby, he spoke with Bloomberg just about an hour ago. Take a listen.
We thought it was appropriate to do something different. It starts with, the environment has gotten more difficult. There's more macroeconomic uncertainty, that people are fearful of a recession. It hasn't happened yet, but that they're fearful of a recession. And so we wanted to also give investors some outlook on what we think a recession could look like.
Joining us now, Bloomberg's Siddharth Phillip, who has covered airlines very, very closely for us. A lot of ripple effects across the industry. Some of the more critical parts have been holding up. What did you make of his decision to give dual forecasts at this point in time?
I think it sort of gives the market some indication of whether there's a bottom on the sort of pain that the industry could possibly face, because last week Delta Airlines came out with their earnings and they sort of pulled their forecast for the year. So this sort of gives more clarity and bookends the sort of range that where things could possibly land, and that's sort of where the industry expects to sort of be, and that could also give it some sort of momentum. Given the fact that even their worst case scenario talks about how they will still be profitable, and so they're still talking about how things look good in terms of the long run.
Yeah, I think it's an interesting move that makes a lot of sense, because who really has a crystal ball in this environment? I wonder if this will become the new polling guidance, rather just sort of game plan different scenarios. I know we already heard from Delta, but you think about American reporting next week. Is it possible we could see something similar?
We could possibly see that, because it sort of gives the market a range that they can look forward to, and they can sort of make their analysis based on, and they can sort of give investors some reassurance that things are not as bad as they could be.
All right, Sid, great to have you here with us in New York covering airlines. Sid Phillip, typically in London, covers global airlines for us. We are less than 12 minutes to the opening bell. We begin the trading day with State Street's Lori Heinel, so stay with us for that. This is Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Equities are not that cheap. The US market is still trading at around 20 times earnings. That's around the 80th percentile. We don't think there's a lot of downside in valuation, but I think we do see more downside in earnings estimates. They're already decelerating quite rapidly. Our numbers are below consensus. And I think as those earnings numbers continue to come down, we're vulnerable still to a further correction in the nearer term.
Peter Oppenheimer on Bloomberg this morning talking about the risk of a further correction. So let's keep that conversation going now with State Street Global Chief Investment Officer Lori Heinel joining us now. Lori, it's great to have you with us, and I'm curious to hear your thoughts on where we are in this sell-off, because it looked like last week there was some more optimism coming into the market, but Peter Oppenheimer makes the good point that we're on the brink of earnings season, and you've seen earnings estimates come down pretty mightily over the past couple of weeks. So it's unclear whether that's going to bring any comfort to this market.
Well, it's really hard to get out of this mode where there's going to be a lot of volatility with this. First and foremost, we still don't know where all of the tariffs are going to land. There's still a fair amount of changes going on, negotiation that's happening. And so until we have a real baseline that we can start to build from, that's going to weigh on market sentiment pretty heavily. Second thing is we are going to see companies, as they go into this earnings cycle, maybe have a good Q1, but expressing a lot of uncertainty about what the forward quarters bring. And so again, investors don't like that kind of uncertainty. And then thirdly, we have a bit of exhaustion going on. I mean, certainly consumer health is still pretty strong. Employment is still pretty good, but there is this sort of feeling that the next leg on some of those fundamentals is going to be lower as well.
You know, there's an expectation that businesses will not do anything because they're so confused by the whole tariff situation. I mean, nobody knows how to sort out who has to pay what. And as a result, we saw the Bank of America survey show that fund managers went from 17% overweight in February to 36% underweight this month, which is the biggest 2-month drop in history. Do you think that we're going to see any turnaround, any clarity here that would be reason to buy?
Well, I think your point about companies are going to be a little reticent to do anything major in here is spot on, but doing nothing is doing something also. One of the great things at the end of last year and coming into the early part of this year is we were starting to see CapEx, for example, and so now companies are more likely to pull back on that. If you think about hiring plans, companies are likely to look at those kinds of things. So doing nothing is also doing something, and that's not a good signal for the market.
Well, on that pause, how deep does it get? If you're pausing hiring plans, do you also maybe exit some locations? Does it have a real estate impact? What I'm wondering, Lori, is when does this pausing of business activity become stepping back from business activity?
Well, in some sense, it's already happening, right? So it's already happening in terms of the total quantum investments that companies are willing to commit in this environment. But it's also redeployment of those investments. So you think about companies that built resiliency or what they thought was resiliency into their supply chains when we had the first administration and the Trump tariffs. Now they're rethinking that. So I think there's just going to be a lot of digesting. But until we have some sense of what the forward looks like, it's hard for companies to nail that.
So, Lori, let's bring this conversation to the markets. How do you structure a portfolio around some of the different cross currents that we're talking about and that fear of a potential slowdown hitting U.S. shores?
Well, there are several things. I mean, I think first and foremost, this is an environment where you want to be diversified. You want to have a little bit of cash on hand to take advantage of market pullbacks. You want to have things like gold in the portfolio that have diversification properties against a backdrop where, you know, stocks and bonds have been highly correlated. You also want to disperse across the region. So if you think about at the end of last year, you know, U.S. equities were almost 75% of global equity indices. Well, now that rebalance is happening also. So think about places outside the U.S. And then lastly, get a little defensive in here. Think low volatility, think dividend payers, think quality.
Lori, what do you think about bonds? Are they a diversifier, given the volatility we've seen and the potential for more sell-off?
Well, we think that they are, and certainly where 10-years are right now provides pretty good opportunity. But again, one of the hallmarks of 2025 year to date has been bond market volatility too. So think about bonds in your portfolio as that longer-term diversifier, but try not to trade too much around it because I think it's going to be a tricky asset class to navigate over the coming months.
All right, Lori, you're sticking with us through the opening bell. Hang tight. That is Lori Heinel of State Street. I want to get a quick check on this setup before we head into the ringing of those bells. You can see the sell-off underway and then some in the S&P 500, now down more than 1%. All of that comes down to NVIDIA. Not quite all of it, but that is what is dragging sentiment down, and that is what is really weighing mathematically on these benchmarks, including the NASDAQ 100 down 1.8%. The small caps relatively buffered here. Of course, NVIDIA isn't in that index. It's all those small companies, but still, you think about this shaky sentiment, all of this uncertainty over trade policy, and that's what you're seeing expressed in the small caps right now, even though you could make the case they're more insulated from some of these geopolitical factors, these cross-border factors.
Right. Small caps are something that I ignore on a regular basis. I'm really concerned about what happens with NVIDIA. It's worth thousands of billions of dollars.
Just thinking about your 401k.
And I want to just point out, there's a great function on the Bloomberg, WGT. So any equity that you type into the Bloomberg, you can type WGT Go, and you'll see how heavily weighted it is on any of the indexes where it's a member. So on the S&P, NVIDIA is worth more than 6%. On the NASDAQ 100, it's worth almost 8%. On the composite, it's worth 10%, and it's even on the Dow Jones Industrial Average.
We don't talk about that.
And in the past, these might have been safety trades. In this environment, maybe not the case. Stick with us. A few minutes away, less than 5 to the opening bell. Stick with us. This is Bloomberg.
another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You're looking at futures that are being weighed heavily by chip makers, specifically NVIDIA, as it looks to work around production curbs, or I should say export curbs to China. S&P futures off more than 1%. NASDAQ futures now down 2%. You hear the opening bells, and it's like farm animals are everywhere. On the New York Stock Exchange, Gallup New York City, which is apparently some kind of charity that helps people with horses, ringing the opening bell, so a good one for Katie there. And then Webull, probably a better one for me, down at the NASDAQ. This company got together with a SPAC and saw its market value increase by 500% over the last couple of trading days. So it's almost like the meme stocks are back for a stock trading app. Katie, what are the other stocks that you're watching this morning?
Yeah, it feels like 2021 for Webull. I can't say the same when it comes to NVIDIA, because NVIDIA down mightily after it said that the U.S. has banned sales of its H20 chip in China. That's a move that could cost the company more than $5 billion this quarter alone, Chanel. And remember, they designed that product line explicitly to comply with previous U.S. curbs, so a lot of whiplash there.
I got more whiplash for you, Katie. I'm looking at AMD down another 7% at the market open. They are also seeing a write-down from U.S. export controls for one of its top chips. AMD says it will cost the company $800 million to curb exports of its MI308 chip.
All right, United Airlines is another one that we're watching. Uncertain about how the trade war will impact its business. Yesterday, it came out with two possible forecasts in case of a U.S. recession. You can see that investors maybe like that transparent method, and the shares are up 1.7% in a down market. But let's get back to NVIDIA. The company is in the middle of this U.S.-China trade war with an outsized impact on the global economy. To put it into context, NVIDIA's market capitalization accounts for 2.5% of all of the global stock market. So I was just talking about the indexes it's listed on here. I'm talking about the entire public universe. Bloomberg Intelligence senior analyst Mandeep Singh joins us now. So how serious is this, Mandeep, for NVIDIA and for the world?
I mean, I focus on numbers. So when you look at, consensus numbers for NVIDIA's growth this year, it's 55% still. And this is a $5 billion charge in terms of revenue. It's more, 15 to 17 billion. So we are talking about almost a 7 percentage point impact in terms of revenue growth. Now, combine that with hyperscalers. We have already learned from Google and Amazon, they're not cutting back CapEx. And the 4 hyperscalers are expected to grow CapEx, 45% this year. The question was always, where is NVIDIA going to find that incremental 10% growth when it comes to meeting their numbers this year? And now that, you know, you take out the China revenue contribution, it gets even harder to get to that 55% growth. And the other thing that's the market is focused on is the gross margins for NVIDIA. Maybe this could be a slight positive on the gross margin side because the H20s were the low margin products. The high margin are the Blackwell. Right. So they could allocate more of the capacity to Blackwell in theory, but nobody knows how it's going to shake out.
Mandeep, it's striking to me that this goes beyond the Trump administration. I mean, you think about how the H20 came to be. It was designed by NVIDIA in 2023 in response to the restriction of another China-focused processor that they had designed. So in a sense, I mean, limiting NVIDIA exports to China, this is bipartisan.
Well, I think so. And look, when it comes to these sort of decisions, I mean, tomorrow there could be a deal between this administration and China that could open doors theoretically. But I think the worst case scenario is the China revenue for NVIDIA goes to zero probably in the next 2 years. There's a very high chance.
Wow, dude, say that again, because that's big. China revenue for NVIDIA goes to zero?
Yeah, I mean, if there's a complete ban, in theory, you could see that happening. The question is, where is the other pocket for demand when it comes to NVIDIA chips? And right now, we keep hearing the market is undersupplied for NVIDIA's. I mean, OpenAI, everyone wants more GPUs. So in theory, a lot of that demand could go to, you know, the LLM players here in the US. So I do think, you know, it's interesting in terms of the gross margin impact and who can take that slack when it comes to, you know, demand past the hyperscalers, but that's the number one question
here. To what Mandeep is saying here, you have that downside scenario, but like UBS said in a note this morning, there could be silver linings. There could be silver linings. That is Mandeep Singh of Bloomberg Intelligence. We're going to get now back into the broader market. State Street Global CIO Lori Heinel joining us. And when you think about the whale in the room that Matt was talking about, how big of a weight NVIDIA is to this market, maybe in prior cycles, NVIDIA or the other large hyperscalers would have been a place to hide, especially the larger tech companies that are holding cash, where the cash is seen as safe. But what about this environment? What do they look like to you?
Well, first and foremost, we've been talking to clients for quite some time now about broadening out their exposure. There have been a lot of concentration risk in the markets. So looking at things like more equally weighted indices or capped indices or other things that take a little bit of that idiosyncratic risk off the table is something we've been talking to clients for quite a long time. But I think the other thing that we're observing is over the next quarter or two, analysts are going to earn their keep. There are going to be lots of crosswinds, and sometimes the headline might seem quite negative, but when you look at the fundamentals, that may actually not be such a big deal, and the converse is going to be true as well. So I think, again, part of the challenge is we don't know what the landscape looks like. Once we have something to deal with, then we can start to respond more fully.
Let's go global, because you've seen renewed calls for going to look at European markets, for example. The sort of pushback there would be that, okay, if you have the U.S. economy weakening, that's not good for the global economy. And Europe really also has a ton of trade uncertainty as well. But how are you thinking about European exposure in particular?
Well, we acknowledge that this uncertainty is not a uniquely U.S. phenomenon, but there are things that give us more comfort around Europe. So, for example, there was the Draghi report some time ago that seems to be motivating European countries to relax some of their legacy constraints around, you know, their fiscal capabilities or thinking about investment more broadly. Certainly, some of the tariff discussions have upped the ante on that. So we actually have been positioned overweight to Europe over the past several months because we do think that there's an impulse there that may lead to better outperformance going forward.
In terms of the good assets or the assets that you still like in America, what are they, Lori?
Yeah, well, look, I think the name of the game is being a little bit more defensive here. So you focus on things like consumer staples, you look at relative valuations, so things like financials look pretty attractive, perhaps utilities. You know, it's hard to get too excited about energy just because of the price action in oil, but if you do unleash this kind of, you know, deregulatory regime and a bit more focus on energy production here in the U.S., that could be a place where you catch a bid. So there are places to weather this storm outperform a little bit, but they all have a certain amount of risk attached to them.
Lori, we thank you for your time this morning. That is State Street Global CIO Lori Heinel. Now coming up, NVIDIA warns that higher curbs on their exports to China will cost them billions of dollars. We've been talking about the impact. We're going to talk about it more next in a deep dive on tech. This is Bloomberg Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, welcome back to Open Interest, a check on stocks about 11 minutes into the session. You can see we're off our worst levels of the session. The S&P 500 down 0.9%, but it's still not looking good. A lot of that pain coming through the NASDAQ 100, through NVIDIA specifically, dragging the benchmark down about 1.6%. As discussed, it's small caps, those domestically focused small companies, your relative outperformer today, but still in the red. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Target getting downgraded over at Goldman Sachs. The firm citing tariff risks and worries about discretionary spending as inflation and uncertainty takes a toll on consumers. Next up, U.S. Steel also getting a downgrade over at J.P. Morgan on tariff uncertainty and questions surrounding the future of its potential deal with Nippon Steel. Never-ending questions when it comes to that deal. But finally, Lyft also getting rated as a new buy over at Oppenheimer. The analyst expects ride-sharing will grow as the challenges of car ownership increases. A little bit bleak there, Sonali, but shares up about 1.3%.
And back to NVIDIA. NVIDIA shares down in the early trade because on Monday, the president celebrated the chip giant, calling it one of the greatest companies in the world. But then now, today, we get a warning from the company saying that it could take around a $5 billion hit from new, tighter U.S. curbs on the chips that it exports to China. Joining us now, Sarah Kunst. She's the founder and managing director of Clio Capital, a venture capital fund, and a longtime investor in the world of tech. So you take a look at what NVIDIA is saying, and NVIDIA is such a giant in the room that when it sneezes, it's one of those things where you have to imagine a lot of other places catch a cold, isn't it?
You know, it is, and people certainly do not like hearing this news from NVIDIA, but the reality when you actually look at their numbers is this is a company with a relatively low PE ratio. It's not massively overvalued like some of its tech peers. Jensen has been doing this for a long time, walking this tightrope between two not-so-friendly superpowers. And so, you know, I think that we'll see in the coming weeks and days what it looks like, but I personally think this might end up being a net buying opportunity for NVIDIA, even if it is causing pain for the larger market.
We hear, Sarah, that NVIDIA is supply constrained, and analysts like Mandeep Singh tell us if China stops buying their chips, that's okay because there's so many people out there, so many companies out there that want them. The market is not a problem. How do you think it'll work out in terms of margins? Do they go from 80% to 70 to 60?
Look, when you're talking about going from 80 to 70% margins, that is a good problem to have. It's still a problem, right? I'm not trying to beat the stock back up. I think we're going to see a dip in the coming weeks, but the reality is this is a company that is operating from maybe one of the strongest starting points in the entire market. And so, yeah, I think we will see some pain there. It's just that they are big enough. They have enough cash. They have low debt. You know, they're talking about a $5.5 billion hit. They made almost $2 billion last year in interest alone on their assets. So, you know, I don't think that this is some sort of existential moment for them. It's just a moment that reminds us that NVIDIA is a real company that has to deal with gravity like everybody else.
So compare and contrast here, because point taken when it comes to NVIDIA, you see it as a buying opportunity, but compare that to an AMD, for example, which is also out with news this morning that it sees an $800 million charge from that export curb on AI chips. You can see shares down about 6%. Is that a buying opportunity?
I would be very hesitant there. You know, it's a good company. I like what they're doing, but the reality is that, you know, since that IPO, they just have traded at an incredibly high valuation given their earnings. And so, you know, I would be hesitant to run in when they are, you know, valued so much higher comparatively against revenue with lower margins, you know, than an NVIDIA or even an ASML.
I want to pull up what the Philadelphia Semiconductor Index has looked like year to date, Sarah, because almost every component is in the red -1 KLA. But you look at declines north of 30% for a fair number of them, some down more than 40-50%. Point taken on NVIDIA, valuation correction. But do you think when you look at this industry with the challenges that they're facing in this tariff escalation, that NVIDIA might be the relative safety in this group?
I think that, you know, because NVIDIA is so big, they've been doing this for so long, and they have a real business that at least for the next few years is relatively hard to compete with head to head. I do think that they are a point of relative safety. I also think that names like ASML are going to be less impacted. If you are well performing, and, you know, I think it could be an advantage for some of these companies that don't sit in the US or China. They have a little bit more wiggle room to sort of keep everybody on their good side. And so, you know, I don't think that NVIDIA is the only name to flee to right now, but I do think that it's certainly one of the strongest companies, as we've all seen over the past couple of years.
We come to you, Sarah, because you invest in this stuff. This is, you know, what you live, sleep, eat, and breathe, technology investment. Is there a possibility that a challenger comes up and dethrones NVIDIA? You know, I talk to, for example, small companies like Samba, or smaller, I should say, like Samba Nova, who are making chips that are really focused on inferencing more than training, right? So it's not exactly the same thing, but do we shift in that direction?
So, I mean, I'm an investor in companies like Grok, the Google spin out that does chip design as well. And so, yes, I mean, there are interesting startups in this space, but the reality is this is not a software company where you can go from 0 to 1 million, users and downloads in a few weeks and sort of win all of a sudden. There's massive amounts of infrastructure, of knowledge that you have to build, of sales channels. So, I don't think that this is something where in the next handful of months or even the next couple years, we're going to see NVIDIA sort of left completely in the dust. This is not, Friendster versus Instagram. These are companies where it just takes so long to really build a real business. And keep in mind, all that cash that NVIDIA has in this market where there's not a lot of IPOs, they might also decide to do more M&A shopping because it does seem like this administration is much more friendly to that than the last one. And so if that happens, some of these rivals you're talking about could end up, working for Jensen.
All right, someone needs to change their name because Grok and Grok is very confusing. A lot of folks immediately go to the Elon Musk startup there and their chatbot. But Sarah, given that you do have this interesting view into the private markets, it's where you also invest as well, the pain, the stress that we're seeing in some of the largest companies out there, NVIDIA just being one example, are we seeing some similar issues pop up in private markets, or what does the landscape look like there?
The landscape is very, very quiet in private markets right now. I think a lot of people had been waiting for liquidity and had hoped that the IPO market would open back up with this new administration. That certainly hasn't happened. We're seeing the opposite with a lot of companies pulling their planned IPOs or pausing them. And so, there is a demand for liquidity from LPs so that GPs can raise more money and get back to work. And it's unclear exactly where that's going to come from. There's only so many secondaries you can sell. And so, there is this slowdown right now. The names that we're seeing raise at crazy valuations tend to be a very short list of people who are often, OpenAI technical co-founders who've left SAM and are charting their own course. And those companies will do well fundraising. And certainly the markets are still open on the private side, but things are going slower. Valuations are a little lower. Most funds have more than enough of their sort of, build a consumer company or enterprise company on an OpenAI wrapper deals that they did over the last couple of years. And so it is a slower environment, even though I don't know that that's super connected to some of these headwinds that the semiconductor industry and the chips are facing.
All right, Sarah, thanks so much for joining us on this breaking story. Sarah Kuntz there of Clio Capital talking to us about NVIDIA and the global trade war. Coming up, Hertz shares soaring in the early trading. That's on news that Bill Ackman's Pershing Square has amassed a fairly large stake. We'll tell you how much and ask why next. This is Bloomberg Open Interest.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing. Just about 23 minutes into the trade, we're down by 1.25% on the S&P, down by more than 2% on the NASDAQ. If this was more than a couple weeks ago, that would be a huge move, but we're used to this kind of volatility, these kind of swings. Interesting to see that the Russell 2000, Katie, is only off by 0.5% right now.
There you go.
Looking at some of the individual movers, obviously when NVIDIA falls 6%, it's going to drag the indexes down with it. It is not a small cap by any means, and that is maybe why the Russell isn't feeling the pain. You see other chip makers or chip making adjacent companies, Micron, ASML, and AMD, all down bigly as well. Tesla off 2.5% today, and this stock, this car basically was one of the big problems for Hertz. But Hertz is now up 15% after we learned of Bill Ackman's involvement. And Katie, with that, I'll toss it over to you.
Yeah, it was up nearly 30% pre-market, that rally being tempered a little bit right now. As Matt said, Bill Ackman's Pershing Square has disclosed a large stake in this struggling car rental company. Let's get right to Bloomberg's Bailey Lipschultz. Bailey, this is interesting from a number of angles, but one of those angles is that Bill Ackman and Pershing Square, they've stepped back from these high-profile activist campaigns. We don't know if that's what this is, but you could make the case that it is.
No, exactly. And they are, again, now they own north of 12.5 million shares, so they're a top 3 shareholder. It is a sizable bet on a company that has, for all intents and purposes, struggled since really emerging from that bankruptcy. The big questions, though, as you mentioned, why is Pershing Square taking this bet? What does that path forward look like? We know that they took a sizable stake in Nike, and that stock has done nothing but move down and to the right. So another interesting strategy, but again, as you mentioned, this stock was up markedly higher in pre-market trading and now has given back a chunk.
Well, can we talk a lot more about what the challenges are at Hertz? Because just a couple of weeks ago, we had reported, a couple of days ago, I'm sorry, that they had hired Ducera Partners. What this means is they hired one of the most bare-knuckled firms in restructuring on Wall Street to deal with their debt load. So does this signal a turnaround? They are up in the stock market 14% this year.
I mean, they're up this year, but they're still down pretty heavily.
I think a lot of those gains came just from today.
Yeah, they're up. They're down 37% in the last 12 months, and again, they did reemerge from bankruptcy.
You could say all of those.
Yes,
all of the gains. All of the gains.
But to your point, I mean, total debt, according to the terminal, $18.5 billion. This is a company also that about half of the shares currently sold short.
That's a chart you like
Right,
to
it's
see.
gone nowhere.
Brutal.
Yeah.
It's gone nowhere. It's fair enough.
Yeah, it's tough when you're down 84%. I guess it could be worse.
You got to buy the bottom somewhere, I guess. Maybe.
Bankruptcy was not the bottom?
Potentially.
Well, one of the bankruptcy was before Knighthead bought them, and before they bought, what did they bought like 100,000 Teslas, or at least they agreed to buy something like that. And then it turns out, like, if you knock a wing mirror off a Tesla, which people who rent cars often do, it costs like $2,000 to repair it. So yeah, that's I think the
Matt, speaking from
the problem.
experience there, Bailey Lipschultz, great to see you. Great roundup on this Hertz news. Really interesting there. We have a great next hour coming up. We're speaking to Evercore's Ralph Schlosstein. He is in the building. Plus, Larry Summers joins this show. We're also going to be speaking with a guest of yours, Matt Miller.
I'm very excited because as CEOs around the country are trying to figure out how to make stuff in America, we have someone who's doing just that, producing motorcycles in Michigan. The owner of Buell will join us on Open Interest.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The Trump administration is suing Maine's education department. The offense, according to Attorney General Pam Bondi, not complying with the administration's push to ban transgender athletes in girls' sports.
We are also considering whether to retroactively pull all the funding that they have received for not complying in the past.
Bondi, joined by University of Kentucky swimmer Riley Gaines, who's been part of a campaign opposing trans athletes. Anger erupted at a town hall in Iowa over the administration's mistaken deportation of a Maryland man to prison in El Salvador. Constituents confronted Republican Senator Chuck Grassley.
I just want to know if you're proud of voting for Trump and what he's doing in office. Are you proud of everything he's doing right now?
There's no president I've agreed with 100%.
I didn't say that.
The administration's refused to comply with a Supreme Court order to bring Kilmar Abrego Garcia home. Shoppers opened their wallets wide last month. The Commerce Department says retail sales rose a better than expected 1.4% in March as Americans rush to buy big-ticket foreign products before President Trump's new tariffs kick in. Business analyst Jill Schlesinger.
This report does show that consumers really are taking seriously the idea that car and truck prices will be rising and that appliance prices could be rising as well.
CBS News confirms the whistleblower who investigated Hunter Biden has been sworn in as acting IRS commissioner.
Gary Shapley testified before Congress. The Biden Justice Department and the U.S. Attorney's Office in Delaware impeded his probe. He told CBS in 2023,
there were certain investigative steps that we weren't allowed to take that could have led us to President Biden.
Last September, Hunter Biden pleaded guilty to not paying at least $1.4 million in taxes. Shapley will serve as acting IRS commissioner until the Senate confirms President Trump's pick to lead the agency. Former Missouri Congressman Billy Long. Michael Wallace, CBS News.
In Rome, doctors and staff at Gemelli Hospital with a big round of applause for the Pope, who visited to deliver mille grazie, 1,000 thanks for their care and attention while he was being treated for double pneumonia.
Grazie a lei per tutto quello che avete fatto.
Pope spent 38 days at Gemelli Hospital before he returned to the Vatican on March 23rd. The Dow's down 257 points at the open, NASDAQ off 360. It's about 2%. This is CBS News. The NFL draft is a week from today, and the league's smallest market is bracing for it.
Just over 105,000 people live in Green Bay, Wisconsin. 250,000 visitors are expected next week for the NFL draft. Local officials are asking Wisconsin to cover $1.25 million in public safety costs.
You just can't be too safe, and we want everybody to realize that they will be safe when they come here.
Lambeau Field has been host to frigid postseason games. It snowed there last week. The forecast for the draft calls for partly sunny weather with highs in the upper 50s, lows in the 40s. Steve Kathan, CBS News.
Snagging the title for the fastest growing suburb, Woodbridge, Virginia, located just a half an hour south of D.C. Banking Rate says the population soared by 4,000 to 43,000 over the course of 5 years. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Brokers Studio in New York City. To our worldwide audience, we are streaming live on YouTube, so check us out on youtube.com. Search Bloomberg Podcast Live. That's where you'll find us. Nora Melinda sitting in for Alex Steele, who's out today. Nora, thank you so much for joining us.
Thank you for having me.
All right, we're going to have a good couple hours coming up here. We're going to start off with Mandeep Singh, Bloomberg Intelligence Senior Tech Analyst. A lot of news coming out of the tech sector here today. Tariffs. We're starting to see some companies put some price tags around the tariff costs for them, so we'll break it down with Mandeep Singh. Margie Patel, Senior Portfolio Manager at Allspring Global Investments. We'll get her thoughts on these markets. And at 10:30, Wall Street time at the bottom of the hour, former Treasury Secretary Larry Summers speaks with Bloomberg Television's anchor David Weston. We'll simulcast that with television. We'll see what Mr. Summers has to say. We'll check in with Michael McKee, Bloomberg International Economics and Policy Correspondent. We'll get his thoughts on some of this economic data that we're getting these days. So a lot coming up in this first hour. Stocks are selling off here again today. Let's check in with John Tucker. Get a Bloomberg Business Flash, John.
All right, thanks, guys. And this Bloomberg Business Flash is being brought to you this morning by IBKR. Will the year-over-year change in the U.S. CPI exceed 2.6% in April 2025? At IBKR Forecast Trader, the yes was recently at 26%. I'll start predicting today at ibkr.com/forecast. Last trading day for this contract is May 12th. The major averages all lower, and trade uncertainty still reigns supreme. Tech leading the stocks lower. Information technology, communication services, the worst performing sectors right now in the S&P 500. That's where NVIDIA lives, one of the worst performing stocks in the index right now. They announced they're beginning subject to restrictions on the H20 chip exports to China. They're going to take a $5.5 billion charge as a result. Meantime, Liz Ann Saunders, the chief market strategist at Charles Schwab, says, it's anybody's guess as to whether markets have hit bottom.
Trying to pick tops and bottoms is a fool's errand. Based on history, even though there's not a lot of historical precedents for what we're dealing with now, it would not be uncommon to see a retest of the lows.
Abbott Laboratories' best performing stock in the S&P 500 was the medical device maker, reaffirming its annual guidance. They're also going to make new investments in U.S. manufacturing. That is a tariff move. And if you can't make a forecast, all this uncertainty, make a couple of forecasts. United offering dual forecasts and also warning of a recession risk. United Airlines shares, they are higher right now. S&P 500 overall, 66 points lower. That's down 1.25%, 53.29 at the index. The Dow Jones Industrial Average down 250 points. Right now, the NASDAQ 100 down 378 points. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Guys, good to see you. Almost there.
Almost
Friday.
there. Hump day.
Friday.
Wednesday.
Friday's off.
Friday's off.
And you're taking tomorrow off.
Exactly.
So today's your Friday.
This is the end.
Oh, okay. Very good. All right, we'll go out big here today. All right, we got Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's take a look at some stocks on the move today. We're joined by Bloomberg's Bailey Lipschultz. Bailey, what are you looking at?
Yeah, I know you guys are going to spend some time with Mandeep later on talking about it, but NVIDIA, biggest driver to the downside in the S&P 500, down more than 6%. This comes after the company warned it will report about $5.5 billion in write-downs for the current quarter, all because their H20 chips will require a license to be exported to China for the indefinite future. Another headache coming from this ongoing trade war. And again, this is a big move for a big company. So you don't normally see NVIDIA down 6%, $2.5 trillion company. So that's providing quite a bit of selling pressure across major averages.
Definitely weighing on peers. We're seeing information technology, the worst performing sector in the S&P 500 right now.
Yeah, and SOX index, I know ASML is having its own issues, but the SOX index right now down more than 3.5%. So a sharp sell-off for tech names and kind of a flight to risk. I know JT mentioned it, but Abbott Labs, Chevron, United Health, investors seeking safety, just given all the volatility that continues to play out.
What's going on with Hertz? I'm a gold card member at Hertz. That means when I walk up there, the cars just kind of see the name up on the thing, you just walk to the car.
I love that. We were talking on TV about it. So did you ever rent a Tesla from Hertz?
No.
Okay, well, that's been their big headache.
Okay.
But the stock's up right now 15%. This comes after Bill Ackman's Pershing Square disclosed that they bought 12.7 million shares. So they're now a top 3 shareholder.
Wow.
Stock's up 15%, but since it emerged from bankruptcy back in 2021, down 84%. So buying a dip, buying a plunge. Just want to call out that one of the more recent high-profile names that Ackman took a stake in, Nike, announced that stake back in August. The stock's down more than 30% from that point in time. So an interestingly rough go for some of these names associated with Bill Ackman. We'll certainly be keeping an eye and trying to figure out if it's an activist bet or him buying the dip.
Because they went long Tesla, right?
Yeah.
In terms of they put a lot of cars into their fleet, and then it became clear that they weren't really working out, I guess.
It wasn't working, and then also it's, as Matt Miller made the point on TV, if you, you drive a rental car like a rental car, and you ding the rear view mirror, it's pretty expensive to replace one of those, as opposed to, a Toyota where parts are bit cheaper.
Exactly. Yep. You're also keeping an eye on United. What's going on there?
Yeah, United Airlines was up more than 5.5%, now up less than 0.5%. So giving back a chunk of those gains. JT had mentioned it. Interesting strategy. They laid out 2 outlooks, blaming uncertainty. Obviously, no one really knows if we're going into a recession or if we're already in one. So they laid out their base case guidance, which maintained and kind of drew applause from analysts, and also a downside guidance in the event that we do go into a recession and consumers feel the pinch. Again, we did see kind of their initial rally partly because it stands opposite of what Delta warned.
Right.
So certainly seeing maybe a divide, but interesting commentary coming from their CEO saying that the weakest region they currently have is domestic. So keeping an eye on U.S. consumers, and if we are going to see a recession or see people kind of slowing their discretionary spending, what that means for this kind of a company.
2 forecasts.
I know.
2 forecasts. They said pick one. We'll see what happens. We got
2 different scenarios. 2 different scenarios, I guess, as they're out there with. All right, we'll see how that plays out. Bailey Lipschultz, thank you so much. We appreciate that. Bailey Lipschultz, equities reporter for Bloomberg News. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. Well, one of the names that Bailey was just talking about was NVIDIA. Stock trading down hard. They're going to take a $5.5 billion charge. Let's break this down with Mandeep Singh. He runs all the technology research for Bloomberg Intelligence. Mandeep, talk to us about NVIDIA in particular. Why are they taking this write-down specifically, and how surprising was it?
Well, it was a surprise in the sense that they're, stopped or barred from selling their H20 chips, which the prior administration approved, and now they're required to get another license. I mean, where you could see, the maximum impact is in terms of what happens with the guide. And look, the consensus numbers didn't really come down, even though we had the tariff uncertainty for the last couple of weeks. The consensus was around 55% growth for NVIDIA this year. Now, when you look at, this kind of news where they're going to lose, almost $15 billion in revenue to China this year, those numbers look very tough to beat. I mean, even meet the consensus. So, and we have been used to NVIDIA beating and raising. So I do think the numbers do get challenging. And look, in terms of long-term impact, I mean, I can see how China will be a much smaller market given all the back and forth that we have seen with the administration and just, I think what we are seeing overall, with their LLM and AI development. The bigger question here is NVIDIA or for that matter, AMD, the only way to kind of stop China's progress with AI? Or should the administration be looking at a much broader cut? And that would include, the semi-cap equipment vendors like ASML and the other fab-related vendors which China is doing business with to build their own fabs. Remember, these are the ready chips that they're using for AI. They're also investing in fabs. So you have to ask yourself, do you need restrictions on the fab makers and, equipment guys? And that's where it could get much bigger if this escalates, and nobody knows the answer right now.
So, of course, we know NVIDIA, it's the golden star of the group. Everyone looks to them, and expectations remain high for them. How much do you expect this news to actually change or alter earnings expectations? Of course, we know that they don't report until late in May. But do you expect this to change any sort of outlook for earnings from the company?
Yeah, so the good thing when it comes to modeling NVIDIA's revenue is there are 4 main hyperscalers here in the US that contribute about 45% of their revenue. And we know the 2 of them have reaffirmed their CapEx. We are going to learn from Microsoft and Meta when they report earnings if they will keep their numbers intact for the full year. But overall, I think the picture still seems to be good when it comes to the hyperscale CapEx spending for NVIDIA chips. The other big bucket is sovereigns and China. And that's where, now you can poke some holes that if they're losing China revenue, is there any other sovereign that can pick up that slack in terms of, NVIDIA chips? And the market is still undersupplied. So we know they were undershipping the demand when it comes to, how much demand was out there for NVIDIA chips. So from that perspective, it sounds like they shouldn't have a problem, finding buyers for their chips, but that's where the guide will be very important when they report in May.
Who is ASML and what did they announce?
So ASML is the semi-cap equipment player that I mentioned, which is used by all the fab makers. So whether it's TSMC, whether it's Micron on the memory side, Samsung, all these companies rely on ASML's EUV equipment to actually manufacture the chips that NVIDIA is designing. And that's where, if you're banning the chips, but not the equipment sales, then it's pretty much saying, okay, China could, in theory, build a fab that's comparable to TSMC and Micron's fabs and create their own chips. They don't need to buy from NVIDIA and AMD. And that's my point about, the wider export restrictions when it comes to what China is able to procure. But ASML is a durable monopoly like NVIDIA is when it comes to, the equipment side. Every company that uses, the latest EUV technology relies on ASML to buy their equipment.
And ASML ships to China, right? China's a big
they
customer.
have a 30% plus revenue exposure to China. So a lot could happen, but ASML is a European company, so it's interesting to see how tariffs affect them.
Based in Holland. Okay, Mandeep Singh, complex global geopolitics. We're starting to see it in some of the financial results from some of these big tech companies, and we'll stay on top of that. Mandeep Singh, Senior Technology Industry Analyst, Bloomberg Intelligence, coming to our Bloomberg Interactive Broker Studio in New York City, the financial hub of the world. Although Princeton's very nice for those managers that like to stay in real estate. S&P 500 off 78 points, 1.4%. We'll have more coming up. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. This on a day when the sell-off in stocks has resumed, and we have technology shares. They're leading the way lower right now. The White House imposed new restrictions on NVIDIA's chip exports to China. And then you had ASML. This is the chip equipment maker. They tumbled after reporting lower than expected orders on weakness in the chip sector. In the meantime, the World Trade Organization also slashing its forecast for merchandise trade this year. We have the dollar weakening, gold setting a record high, in the Swiss franc, which we're going to call a haven currency, that is rallying. Fed Chair Jerome Powell is scheduled to deliver a speech later today. Everybody's going to be listening to look for signs or hints of any sort of Fed put. We will carry that live, Bloomberg Radio, TV, and podcast that as well. S&P 500 right now is down 69 points. That's down 1.3%, 53.27 on the index. The Dow Jones Industrial Average down 250 points. That is down 0.6% right now. NASDAQ 100, 376 points lower. That is a full 2% lower right now. And shares of NVIDIA, they are down 6.4%. Let me do yields. 10-year, that's unchanged right now, 433. The 2-year is actually down 3 basis points. There is a bid to treasuries on the short end right now at 380. And dollar DXY down 0.6%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Nora and Paul.
John Tucker, thank you so much. We appreciate that. Nora, Melinda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Just looking at the S&P 500, as John was just reporting, off 1.25% today. We're off a little more than 13% now from that peak back there, just a couple of, or back in mid-February. So a sizable move. You know, at the trough just last week, we were down close, just right around 20% in that bear market territory. What's the professional to do here? Margie Patel, she joins us, Senior Portfolio Manager, Allspring Global Investments up there in Boston. So we're doing the Zoom thing. Margie, what are the conversations you're having with your clients these days? You know, last week was just an extraordinary week for the markets. This week, we still got some volatility here. What are the conversations like?
Well, I think the big picture is that we had 2 great years in the market, 23 and 24. Both of those years are up over 20% for the major averages. And so this philosophically might be a give back year with equity, maybe even finishing, we think very modestly positive. But right now we're in a pretty deep hole here. So we need a big rebound. And I think really it's just the volatility is not because of anything fundamental in the economy. It's all the uncertainty over tariffs. So fundamentally, the U.S. is still poised to, I think, have modest growth. We've been thinking 1.5%, even before the tariffs. So we're positive on the market, but you have to get through this uncertainty period.
So what is your takeaway from today's sell-off? Of course, we had a crazy week last week, and then we got a little bit of a reprieve, and now we're back here into the red. NASDAQ down about 1.9%. What's your takeaway as you're talking to clients about how to view technology and AI?
Mm-hmm. Well, I think that you can't really get optimistic about technology till we get through the earnings season, which in technology we really haven't. We've just really started. And to see what companies, not only what they report, but also what their outlook is for the second quarter, third quarter, to the best of their ability. And realistically, it looks as if they will be more on the cautious side or negative side. So we may have to wait for a few months to see technology bottom and then do better, because it's still one of the secularly growing parts of the economy. So it's, you know, the reason you make so much in technology is because you have to ride out these periods of extreme volatility.
So, Margie, I guess, is there, just as we kind of get into the teeth of earnings season here, what's the earnings risk, if any, you see in this marketplace right here?
Well, for the first quarter, things look pretty good, more modest, I think, than we saw last year. We're thinking, say, 8 to 10% will be the reported earnings growth. And then, of course, everything depends on what companies see for their outlook, how much they're willing to commit and have an opinion about what their outlook will be. But we think that the economy is pretty well balanced. And what's really different now when people talk about recession is every recession we've had has been due to the Fed slamming on the brakes, raising short rates, pulling out liquidity, and precipitating the recession. And so this time, I think we might have, say, second, third quarter, a mild negative GDP number because of the uncertainty. Companies just waiting to see what happens, 0.25%, something like that, negative GDP. But that will be about it, because unless the Fed is on a long-term aggressive tightening cycle, I just don't see how we get a recession. And clearly the Fed's message is they're sensitive to the economy, they're sensitive to the needs and liquidity needs, and companies' liquidity needs are in pretty good shape. So it's hard to see much of a, other than a tariff-induced little negative jostle in the marketplace.
So we've spoken to equities. What's your view? How are you thinking about other asset classes like the bond market, currencies? What are you thinking right now?
Well, I think that U.S. high yield public bonds look pretty good for an investor who just can't take the volatility. Those yields are, say, between, say, 6.5% to maybe 8%. And I think that the high yield market actually is in very good fundamental shape because those companies have pretty much spent the last 10 or 12 years rebuilding their balance sheet. So they really are not as sensitive to a drop off in rates, and certainly not to if the Fed would raise rates, which doesn't really look like it's in the cards. So we think that's a very attractive sector. It's not as high as we've seen in other sectors, but defaults are only about 2%. So we think it's a pretty good sector for someone who wants a little bit more than, say, a money market rate.
Margie, thank you so much for joining us. Really appreciate it. Margie Patel, Senior Portfolio Manager at Allspring Global Investments up there in Boston, Massachusetts, joining us via Zoom. Coming up in just a couple of minutes here, former Treasury Secretary Larry Summers speaks with Bloomberg Television's anchor David Weston. So we will bring you that conversation in just a moment here. Resetting the kind of where we are in the marketplace right here. A sell-off continues today. We have the S&P 500 off 60 points. That's 1.1%. The NASDAQ taking it a little bit harder, off 315 points at 1.9% decline here. Again, on back of some of the NVIDIA and some of the other tech names, some of the chip names, are ASML, AMD, NVIDIA talking about the impact. Yeah, this is because they sell a lot of chips into China, and they're trying to quantify what some of the risks might be. So we're starting to see some announcements out of those companies. The earnings, as Margie has mentioned, you know, the few that we've gotten so far, like the banks, have generally been very good.
I was going to say.
The trading desks have come back pretty significantly, but they do suggest that the advisory work is coming in a lot lower. So as we get more of these companies reporting, we'll see how they choose to forecast whether they do the United Airlines route, which is maybe a couple of different scenarios, or whether they pull it in general. The bond market, 10-year Treasury, 4.34%. Right now, former Treasury Secretary Larry Summers speaks with Bloomberg Television's anchor David Weston about general economic issues. Let's go to that right now.
For our Bloomberg audiences worldwide, I'm David Weston, and we're joined now by Larry Summers of Harvard. Larry, thank you so much for joining us. You've spent much of your career when you were in Washington as a professor at Harvard and then as president of Harvard as well. So we want to ask you about this letter that came in on Friday from the United States government. I've read the letter carefully. Set aside for the moment some of the things that some people find draconian. Does the Trump administration have a point, particularly with respect to dealing with anti-Semitism and diversity of viewpoint? Those are things you have spoken out on before.
David, I've been sharply critical of Harvard, and I continue to be critical on many dimensions. Anti-Semitism is still not responded to strongly enough. There are still excesses of identity politics. There's still concerns about intellectual diversity. That's all right. But here's the thing. In America, you have to follow the law. And the approach the Trump administration is taking of simply announcing an across-the-board freeze is wildly extra legal in its approach. It is not at all consistent with the Civil Rights Act. It is probably not consistent with Harvard's First Amendment rights. And so the right thing to do was surely for Harvard to respond vigorously and strongly. All the more because this is not an isolated thing, what's being done to Harvard. This is not a manifestation of a particular concern about aspects of universities. This is a part of a broad and sweeping effort to suppress institutions that challenge the presidential administration. It's part of what's being done to law firms. It's part of what's being done to countries. It's part of what's being done to judges. It's part of what's being done to legal residents of our country. And if an institution like Harvard cannot resist tyranny when applied to it, with Harvard's $50 billion endowment, with all its network, with all its prestige, then who can? So Harvard should not go interjecting itself into politics. But God, when it is the object of an extra legal set of orders and threats, I don't think it had any viable choice at all but to respond strongly.
Larry, let's talk about that extra legal part of what you're saying. Elise Stefanik, the representative, Republican from New York, actually gave an interview today on a rival network saying, listen, colleges like Harvard don't have a right to money from the government. They don't have a right to taxpayer money. And if they don't have a right to the taxpayer money, can't the government put conditions on that money?
So here's the thing. First of all, the money is not going, it's not like the government's funding the DEI office at Harvard. It's not like the government is funding the student discipline mechanism at Harvard. The government is funding researchers who are doing vitally important research on diseases like diabetes and cancer and ALS. So what sense does it make to cut their funding off because somebody doesn't like what the Associate Dean of Students did in a student discipline case? And what remit does the government have to set as a condition the composition, which beliefs are valued and which beliefs are not valued in the Harvard Sociology Department? That's not the way free speech works in a free society. And this is supposed to be done, the power of the purse, remember, by Congress. It is not the prerogative of the executive branch with 3 days notice, with no hearing, no judicial review, no transparent notification to Congress as mandated by statute, to simply indiscriminately start cutting off previously promised and committed funds because it has a disagreement over an issue with the university.
So, Larry, give us a sense of what, as a practical matter, this will mean if it continues through. You ran Harvard at one point. You know the budget. You know that $53 billion endowment there. What will it do to their operations?
Look, they'll have to make some very important strategic choices. I hope that the university will find ways, even if there is a cutoff for some interval of funds, to maintain vitally important programs, to not cut back research. But potentially, if the U.S. government goes to war with our great universities, it means a sharp reduction in the kind of scientific progress that has caused the United States to be the envy of the world and pull so far ahead of Europe and Japan. It means the end of efforts at cures to diseases like cancer and diabetes. It means a substantial risk to our national security, because one of our great national assets has been our capacity for innovation, which resides very heavily in our leading academic institutions. So a short-run problem, I think that can be managed painfully until the judiciary steps in and does what's necessary. A long-run war against the universities, that is going after what is our hugest asset. You know, if I think about all the different sectors of the economy, it's hard to think of one where we are as dominant as in higher education. All the students from all over the world, at least until this administration came, wanted to come to the United States. A vast fraction of the world's innovation takes place in American universities. If we put that at risk, we are making, I believe, a very, very grave mistake.
Larry,
yes, these issues should be pursued, but destroying medical research grants because you don't think people have been disciplined severely enough, it really doesn't make any sense.
Larry, I wonder if there's a cautionary tale here that maybe the higher education system has become too intertwined with the government. That's why they're so dependent upon them.
There may be questions that can be asked of that kind, but gosh, if the government is not prepared to fund basic research, the research which ultimately will make possible the development of new products, I think we have a problem. If the government is not prepared to fund scholarships that promote opportunity for our poorest students who are very able and generate social mobility, I think we have a problem. I think what we need, frankly, is a more mature relationship between the government, the broader society, and the universities. Yes, the universities have made some very serious mistakes, and yes, they should be pressured with escalating strength to change that. I didn't even have an objection to the way in which the Biden administration opened civil rights cases with respect to a variety of universities and anti-Semitism. But that's a very different thing than the kind of persecution that is involved here. And this escalated yesterday, David, in a profoundly troubling way. When the President of the United States endeavored by social media to engage in an individual specific tax matter, namely Harvard's 501c3 deduction, and to suggest that it be decided on the basis of a political ground. That's the kind of interference with the IRS that it's a sacred duty of the Treasury Secretary to resist. It's exactly what was alleged to have happened 6 levels down, and many people got very upset in connection with the so-called Lois Lerner case involving 501c3 deductions in conservative groups. If there was punishment of conservative groups, people were absolutely right to have been hugely outraged about it during the Biden administration. I don't know anything about the merits of the case. But for the President of the United States to be calling for changing the tax status of his adversaries, this is new and I believe authoritarian and a real question about our democracy.
Larry, one last question. Since we're on taxes, and this is tax week, basically, what do you make of the actions that the Trump administration is taking with respect to the IRS?
I think it's possible that the Treasury Secretary and his senior colleagues are being seriously delinquent in their duty. I look at tens of thousands of people being pushed out of the IRS, even as tax compliance is a massive problem, and hear so many stories of increased tax cheating as a consequence. I see the elevation of a person with no experience, no administrative or information technology experience to be the temporary commissioner of the IRS, chosen on the basis of political loyalty to the Trump enterprise. I look at what are probably the extra lawful agreements entered into without even speaking to people at the IRS with respect to information sharing and immigration. I look at the president's involvement in specific cases, and I see the most important line that I thought I was supposed to defend when I was Treasury Secretary. Apolitical tax enforcement. Neutral, professional tax enforcement, not driven by politics. And I see that line being crossed with the Treasury Department cheering it on. And it makes me both very sad and very angry.
Larry, thank you so very much. Really appreciate it. That's Larry Summers, former Treasury Secretary, now with Harvard. I'm David Weston, and this is Bloomberg.
All right, that was our very own Bloomberg television anchor, David Weston, sitting down with former Treasury Secretary and former president of Harvard University, Secretary Larry Summers, talking about kind of what we're seeing between Harvard and the Trump administration. All right, right now, let's get a little bit of a reset here. We can do that. We'll go over to John Tucker and get a Bloomberg Business Flash.
All right, the major average is lower, but all the worst levels of the session. Tech leading the way lower. The chips are down. Advanced Micro Devices, they announced this morning around 9 o'clock Wall Street time they expect to take a charge of as much as $800 million after the Trump administration put new restrictions on semiconductor exports to China. This, of course, comes after NVIDIA made a similar disclosure that it's going to take a write-down of $5.5 billion because its H20 chip will be banned from export to China unless it secures a license. Right now, the S&P 500, 51 points lower, down 1%, 53.44 on the index. The Dow down 145 points. The NASDAQ 100 right now down just shy of 300 points. That is down 1.6%. Meantime, Nadia Lovell of UBS does see some degree of certainty returning to markets.
We are past the peak level of policy uncertainty. And of course, yes, there's still a lot of fog, but we think that the market is more prone to positive headline risk at the moment around tariffs, and that could get priced in pretty quickly.
And the worst performer in the S&P 500 shares of J.B. Hunt Transportation. This is the trucker. Those shares down 8.5%. Analysts point to continuing concerns about the impact of tariffs and the broader economy on the trucker. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Norm Paul.
Back in the day, John Tucker, J.B. Hunt, taking them public, that was the truck. Port of Los Angeles to someplace east of Denver.
And you're the guy who volunteered to actually go on a long
right.
trip.
Exactly. In my suit.
The only one.
Oh, I heard the story.
In my suit, and there were 20 bankers there at the Port of Long Beach. We all got asked, do we want to go on a trucking trip overnight? And I'm the only one out of 20 that raised my hand. So it got me there to Denver, took a cab to the airport, and then flew back.
But you got a taste of what it's like.
Yes, long-haul trucker sleeping in the cab overnight. It was pretty cool. All right, what are we doing here? Let's go to Michael McKee. He's in Chicago, and I think he's in Chicago's Fed Chairman Jay Powell is going to be speaking there later in the day. Michael McKee, international correspondent for economics and policy there. Hey, Mike, we had some retail sales data today. I guess there was some pull-ahead kind of buying that some of us did here to get ahead of what will be some of these tariffs here. I know I did that with an auto purchase or a lease. What did you make of the retail sales? Did it give you any sense of how the consumer's doing out there?
Well, it shows the consumer is doing fine at the moment, or was rather in March. And yes, indeed, they did pull ahead a lot of buying of autos, up 5.3% during the month. And that really pushed up the overall number. When you take autos out of it, it was a much lower increase. And we saw in most categories no real sign of a pull ahead. Electronics were up a little bit, and that might be part of the tariff tax thinking. But furniture was down. We get a lot of furniture from China. Department stores were down. Apparel was barely up. So there's kind of a mixed picture here. People were trying to get ahead of tariffs, it seems, with autos, and they did the same thing in February. But overall, no sign that it was panic buying in a lot of different categories.
So how are you viewing this report in the midst of all the other reports that we get? What's the general trend right now if you were to speak to the U.S. consumer? Where are we?
Well, if you're to speak to the consumer would tell you they're scared to death about what's going to happen. That's what we're seeing in all these soft data consumer sentiment surveys. But their actions so far suggest they still have money to spend. And if they want to, they are willing to spend it. And that was the case in cars. If you thought your car price was going to go up 25%, yeah, go ahead and buy one. The issue is going to be, what do they do when tariffs start really becoming visible and prices start really going up? We don't know what's going to happen because the administration doesn't stick to one tariff plan, and it seems like there isn't going to be a final decision for some time. So it leaves the Fed in the position of not knowing what to do either, which is why the focus on Jay Powell today. What's he going to tell us about what he and his colleagues are thinking?
So, Mike, you're in Chicago, one of my favorite towns. Who is Fed Chair Powell speaking to today, and what do you think his message should be?
Well, he's going to be speaking to the Chicago Economics Club, and it's going to be a fairly large audience, and of course, lots of people tuned in around the world. The question is, what can he say? Not so much what he should say, but he's already said, as have all his colleagues, that if we see the economy weaken, unemployment go up a lot, the Fed could cut rates. If we see the economy stay okay and prices start to rise, the Fed could raise rates. And since they don't know right now which direction it will be, they're happy to sit where they are. Beyond that, there isn't much to say. And you know, we've seen this from companies in the early earnings reports that have come out. United Airlines gave a very similar outlook, saying, you know, if people stop flying, that's really bad for us in our earnings. And if we don't see terrible tariff damage, we'll be okay. So everybody's kind of in the same position. So I'm not sure how much he can add at this point.
Hey, maybe he'll come out with some scenario analysis, you know?
Maybe double.
Exactly. So we'll see how that goes. All right, Michael McKee in Chicago. We appreciate that. Michael McKee, Bloomberg International Economics and Policy Correspondent. He will be covering Fed Chairman Jay Powell's speech this afternoon in Chicago, and he'll have all the reporting coming out of there. And clearly, there's a scenario where, as Mike was just saying, maybe the best thing for the Fed is just to kind of wait and see, like the rest of us, and see how these tariffs impact, or where the levels end up and how they impact economic activity, how they impact inflation. I think a lot of folks around the world are all doing that same thing. And that's kind of what we're seeing reflected in the market, that level of uncertainty weighing on risk assets such as the stock market, where today we see the S&P off 56 points. That's about 1%. The NASDAQ a little bit more here, off 300 points, 1.8% decline in the NASDAQ. Yields kind of stay here. 10-year Treasury up about a basis point, 4.34%. We're going to have more coming up today. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Norma, Linda, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Head over to youtube.com, search Bloomberg Podcast Live. That's where you'll find us. All right, we've heard from the big money center banks, the JP Morgans, the B of A's of the world. We're also hearing from some of the regional banks. And these are some of the folks that are, really have their finger on the pulse of some of these small businesses out there in America. So we want to get a sense of what's happening there in some of these regional banks. Herman Chan, Senior Analyst for U.S. Regional Banks at Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker Studio. So Herman, let's talk. I know Citizens Bank has reported, First Horizon, U.S. Bancorp. What are you seeing from some of your regional banks around the country?
Yeah, I'd characterize the first quarter results as really the calm before a potential storm, given what's going on with tariff uncertainty, economic uncertainty. But first quarter results were pretty solid, as expected, and the banks really didn't change guidance for the year despite bigger economic risks.
So, this is what we're hearing from the regional banks. What are some of the intricacies that you look for in regional banking reports as opposed to maybe the larger banks?
Yeah, well, for the regional banks, lending and the balance sheet is much more important versus the capital markets banks that are more focused on trading results and investment banking results. The balance sheet growth has actually been pretty positive. We're seeing actually a pickup in commercial lending, which has been in the doldrums for the past couple of years due to the higher interest rate backdrop. And for the first time in a while, we've seen a pickup in commercial lending activity. That may be because of a pull forward in inventory building for a lot of these small businesses and commercial borrowers. So that's something that could be a pull forward pickup for them, but maybe less growth going forward for the rest of the year. Some other aspects that we're looking for is credit quality, and that's really the big concern for a potential recessionary backdrop. And haven't seen too much in terms of less confidence in credit quality going forward. But again, there's so much uncertainty that nobody really has a good crystal ball on that.
So in the Q&A section of these earnings calls that you've been listening to, what has management said about the really near term, like the calls they've had with their clients over the last 3, 4, 5, 6 weeks? Is there much? Is there that level of uncertainty that's creeping into their business?
There's uncertainty. The bank management teams have talked about planning for various paths that we could go forward from an economic standpoint, and they're prepared for that. I mentioned earlier, they reaffirmed guidance for the year, but they also acknowledge risks within that guidance in terms of the potential higher bad debt provisioning that could happen with a worsening economic backdrop, less capital markets fees because there's less M&A activity or debt issuance, and less loan growth because typically loan growth does track with economic growth. And if we see less GDP growth, there will be less lending involved with these regional banks as well.
Well, a little over 2 years since that March 2023 regional banking crisis. Is it something that people still talk about on earnings calls, or is it a thing of the past?
It's a bit of old news at this point. While the stocks seem to gyrate, and some of the banks that were sort of in the crosshairs a little bit 2 years ago, banks like Western Alliance, banks like Comerica, they've been hit a bit more relative to peers over the past couple weeks, but for the most part, we haven't seen some of the increased concerns of deposit outflows or things like unrealized securities losses in the securities portfolio. So those are not really top of mind issues now. It's just more the economic uncertainty and where the economy goes from here.
Right.
If we can think all the way back to maybe, I don't know, the beginning of the year before we all got focused so much on these tariffs, there was a sense of animal spirits out there. There was a sense of maybe this new administration would be more M&A friendly.
That's right.
And as the regional banks, that seemed to be a salient point to me because one could argue that there's a sector that perhaps could see some consolidation and would be beneficial to shareholders.
Yeah.
Is there still that feeling in the regional bank community that this is an administration that would allow, maybe not encourage, but allow some consolidation?
Yeah, we've seen a lot of positive, constructive commentary from the administration talking about lessening capital rules for the banks and weakening some of the M&A rules that the Biden administration placed on the banks towards the end of the tenure. So that's all positive, and we've written about it recently, but we haven't really seen a lot of M&A activity. There was no M&A bank deal that was announced with a valuation over $1 billion in the first quarter, despite some better constructive commentary from getting regulatory approval on these deals. That's something that will happen over time. We just haven't seen it given just the uncertainty with the economy and interest rates, and with less CEO confidence, these bank deals could be on pause for at least the near term.
Okay. Herman Chan, thank you so much for joining us. Herman Chan, he's the senior analyst covering the U.S. regional banks for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio. Again, kind of what we've seen from, as Herman was mentioning, for some of the regional banks, similar to what we heard from, the large money center banks, which is their first quarter was pretty darn good. And for the big banks, it was the capital markets businesses that really capitalized on the volatility in the markets, while their advisory businesses were seeing a slowdown in the business. But if you're in a regional bank, it's all about loan growth there, as Herman was just mentioning. So again, the first quarter results were decent. Going forward, a lot of uncertainty, and that's what we've heard from some other companies that have reported. Most notably today, United Airlines, who provided two sets of guidance, two scenarios, if you will, for the economy and how that might impact the results. So we'll see how other companies talk about their forward guidance here, if they do it at all. Dan Ives of Wedbush Security says he expects a lot of his tech companies to actually not provide guidance as they typically do, so we'll stay on top of that. For our listeners in the U.S., reminder, you can listen to us via satellite radio, Sirius XM Channel 121, and that is brought to you by Oracle.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to get the latest on the tariff news. Tyler Kendall, Bloomberg News reporter, she's going to give us the latest reporting there on this fluid situation. Then we're going to check in with Mary Shore. She's a senior equity analyst at Columbia Threadneedle Investments. She joins us to give us some thoughts on what's happening in the world of retail sales as we gear up for another season of earnings here. Shanna Sissel, President and CEO at Banrion Capital Management. She'll just join us to give us her market outlook. So got a lot coming up in this hour, so we stay on top of the markets where there is a sell-off here. We've got the S&P 500 off about 1% right here, so we'll keep an eye on that. Right now, let's go to Amy Morris and get World and National. We'll get a Bloomberg Business Flash.
Let's do it, Paul. The World Trade Organization slashing its forecast for merchandise trade this year. The WTO expects the volume of world merchandise trade to decline by 0.2% in 2025. It's about 3 percentage points lower than it would have been without the trade war, marking a dramatic reversal from expectations at the start of the year. That plus the tech sell-off that you were just talking about, that's moving markets lower. We do check markets for you all day long here at Bloomberg. The S&P 500 now down 1%, NASDAQ down 1.8%. The Dow is down about 0.25%. The 10-year Treasury yield at 4.33% and the 2-year yield at 3.81%. Liz Ann Saunders is chief market strategist at Charles Schwab and says it's anybody's guess as to whether markets hit bottom.
Trying to pick tops and bottoms is a fool's errand. Based on history, even though there's not a lot of historical precedents for what we're dealing with now, it would not be uncommon to see a retest of the lows.
Charles Schwab chief market strategist Liz Ann Saunders. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Intelligence with Paul Sweeney and Norma Linda.
All right, Amy Morris, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio. We are also streaming live on YouTube, so you can head over to youtube.com. Search Bloomberg Podcast Live, and that's where you'll find us. As Amy was just mentioning, we do have red on the screen with the S&P off about 1% here today. Let's take a look at some of the stocks on the move today. We're joined by Bloomberg's Bailey Lipschultz. Billy, what are you looking at?
Yeah, I want to start with ASML, the semiconductor name, under pressure. ADR is down more than 5% in U.S. trading. One of the worst performers alongside the likes of NVIDIA and AMD. This comes after ASML reported first quarter bookings that were below what Wall Street was looking for. Management team was talking up 2026 as a growth year, so normally not the kind of strength that you want to see. The one thing that did stand out from the earnings call and some of the commentary is, as of now, they're saying that tariffs haven't fundamentally changed their planning or discussions that they're having with customers, but they are continuing to monitor the situation. It is evolving, obviously, on a day when NVIDIA's under notable selling pressure after restrictions around its H20 chips being shipped to China. All eyes are on what's going on in the semi space, and obviously a lot of jitters, just given, broadly speaking, the run-up that we've seen in the last few years.
Yeah, we're really seeing a lot of their peers taking it to the chin. We got the NASDAQ down about 1.9% right now. You're also looking at Interactive Brokers. What's going on there?
Yeah, this company reporting earnings, they trade under the ticker IBKR, down right now more than 9%, almost 10%. This comes after their EPS fell short of what analysts were looking for. They blamed, analysts are blaming the slide on their net interest income and higher expenses coming in below what analysts were looking for. The one thing that did stand out looking through some of the notes was the fact that they were seeing an issue around margin balances. And obviously companies like IBKR and some of the other peers like Robinhood or Schwab benefit when people are trading stocks. Market volatility, though, in some of their ability to generate profits from loaning out those shares or people taking on debt to trade stocks, obviously being heavily impacted so far in the wake of Donald Trump's tariff kind of unveiling in the trade war that we've seen.
But it seems like, I guess, I mean, the retail traders are still trading. I've heard, like, you talk to Eric Balchunas on the ETF side from Bloomberg Intelligence. He says the funds keep flowing in despite the declines in a lot of, stocks and bonds and so on.
Yeah, we had a story. I had a story out yesterday, basically, that a lot of these individual investors don't care. And they view the sell-off as a reason to continue to buy the dip. The one thing that stood out to me was some data from JP Morgan said that retail investors, this was through Monday's close, since the tariffs were unveiled on April 2nd, had pumped almost $18 billion into the market. Wow. So a lot of
big numbers we're working with.
Yeah, exactly. I mean, the interesting thing is just the kind of vision that a lot of these individual investors have, that they don't really care. They think that stocks eventually will go back up. And
over the last 15 years, they've been right.
Right.
Exactly. And that's the thing.
That's the thing. So you're also looking at JB Hunt, correct?
Yeah, so the size and scope is tough for most stocks, just given the volatility. JB Hunt, which is in the trucking space, down more than 8%, trades under the ticker JBHT, trading at the lowest level since November 2020. Wow. So when you look at trucking and kind of the idea that transports help drive the U.S. economy, when you're seeing the impact from tariffs, you're seeing the broader economy weighing on trucking stocks. Again, missing expectations. They kind of blamed, obviously, macro uncertainty, rates pressure, but analysts really souring on the stock, slashing price targets. And again, you're looking at a company that right now down more than 8%, but over the last 12 months down 32%. So one of the losers on a broader kind of
if you're calling for slower trade, and again, we had the World Trade Organization today cut their outlook significantly for world trade, and maybe you're not going to be trading as much with your two closest neighbors, Canada and Mexico.
It's really
that's a tough thing if you're a big nationwide trucking company.
Exactly, and it's been looking at it, even looking through some of the notes, like even though intermodal loads rose 7.6% year over year, they basically have been worrying about running the business, and they're actually cutting their CapEx spending, so trying to tighten the belt. Not only are we seeing consumers do that, but a number of companies now trying to kind of assess the landscape and rein in their own spending.
Yep, and that's the type of stuff that doesn't get into the GDP data we see yet. I mean, let's put it yet, but you see it in the survey data that tries to look ahead a little bit, and you see it with the guidance for some of these companies, whether you're a transportation company like JB Hunt or an airline, we're starting to see it in the results in the outlook. Bailey Lipschultz, thank you so much. We appreciate it. Bailey Lipschultz, equities reporter for Bloomberg News. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere else you get your podcast. Speaking of tariffs, we had some more news just recently. It seems like, obviously, it seems like it's something that is impacted on a daily basis, even intraday. And I believe President Trump says he will attend the tariff talks with Japan today. That's kind of interesting to me. Tyler Kendall, it's her job to follow this stuff for Bloomberg News. She's a reporter at Bloomberg News. She's down there in Washington, D.C. Tyler, just that news story here about President Trump says he will attend the tariff talks with Japan today. How unusual is that for a president to involve himself in this level of talks?
Yeah, hey, Paul, it's actually considered to be pretty unusual. Normally, this is done at a leader-to-leader level, but instead we're seeing President Trump today saying that he will be there in person alongside his Commerce Secretary Howard Lutnick and Treasury Secretary Scott Bessent. The administration is making it clear that President Trump says that he wants to be directly involved in these negotiations. And when we're talking about Japan, part of why we know or our understanding is that Japan will get priority in these talks is because Japan's Prime Minister did reach out directly to President Trump just last week, and that has helped sort of spur this relationship when it comes to the U.S. liking that and wanting to then engage with Japan. President Trump says that they're going to be talking about trade imbalances, but also what he characterized as military spending. That's something that perhaps could be one of those non-tariff barriers that this White House tells us so much about will ultimately need to be involved in these talks. And it's interesting to look at who this administration really is prioritizing beyond who has reached out directly to the U.S., but it's also those countries that are geographically close to China, like South Korea, India, Vietnam, all of these places that this White House is really trying to court as the trade negotiations remain stalled with Beijing.
Hey, Tyler, we've really seen Trump remaining fervent in this tariff campaign. What are you hearing on the ground? Are people expecting him at all to back down or to pull back? I mean, we've obviously seen him give some reprieve for certain countries, but how are you thinking about this going into the Japan talks?
Well, broadly speaking, this administration is holding firm when it comes to their tariff plan, although we do have, of course, this 90-day pause with the so-called reciprocal tariff plan. But look at just the sector-specific tariffs. Really, this White House remaining undaunted when it comes to those. Just yesterday, adding another Section 232 investigation when it comes to critical minerals, just one day after launching, or at least formally telling us that they had launched their probes into pharmaceuticals as well as semiconductors. Now, this administration always touts that so far at least 75 countries around there have reached out to this White House for negotiations. The White House press secretary yesterday narrowed that number a little further, saying that there are about 15 countries that have put further concrete offers on the table that President Trump is considering. But really, we know that at least at this part, this White House really does remain undaunted. It doesn't take the market movements or any of the economic concerns, because they are really pushing us towards that this is all about that long-term economic growth.
China has not been quiet, Tyler. China says it is open to talks if the U.S. shows respect and names a point person other than the president, I presume. How is that news landing at the White House?
Yeah, this is really kind of our first insight into potentially what could help bring down escalation, start these talks after they really have been stalled. And a person familiar with the Chinese government's thinking, as you said there, saying that the most important precondition is for Chinese officials to feel like they are going to get respect when it comes to these calls. It appears that they are wanting President Trump to disavow comments from his cabinet members when they are critical of China, wanting him to, sort of take extra steps, even if he himself touts that he has a really good personal relationship with Xi Jinping. But perhaps that pivotal part is what you said, which is that Beijing does want the U.S. to appoint a point person that can speak and act on behalf of President Trump, even as the White House says that President Trump himself will be heavily involved in these negotiations. You heard Caroline Leavitt yesterday saying the ball is now in China's court, and this is sort of the reaction that we're getting, that Beijing really does want to see this happen, perhaps at those lower level first. And we have to keep in mind that there really were trade talks earlier this year, back in February when China was hit with that 20% baseline tariff. But at that point, the discussion was about fentanyl concerns, and it appeared that those trade talks have broken down. And at this point, the gap has only really gotten bigger.
Tyler Kendall, thank you so much. We appreciate that. Tyler Kendall is a reporter for Bloomberg News, and she is based in Washington, D.C. We had retail sales today. They came in kind of right in line with expectations, so it showed some improvement from last month. And the question is how much of that is kind of pulling forward some purchases and consumption on the part of consumers who are trying to get ahead of the tariffs. Mari Shore joins us, senior equity analyst at Columbia Threadneedle Investments. Mari, what did you make of the retail sales data today?
Yes, thanks for having me. As you said, the retail sales data was strong, showed an improvement versus February. I think some of that was driven by unfavorable weather in February, which weighed on that monthly result. But I don't see consumers, as you just suggested, really pulling forward buying ahead of expected tariffs. I think the underlying demand trends had been very stable, with continued outperformance in categories like apparel, beauty, and home furnishings. But again, I think investors are taking the results today with a huge grain of salt, given the heightened tariff and recession risk that lies ahead.
So you mentioned that people are taking this individual report with a grain of salt. What are you seeing as the broader narrative for the U.S. consumer right now?
It is incredibly unclear, uncertain, volatile. I've met with many companies over the past couple of weeks, and honestly, they're, I would say, just as confused as investors and consumers are at this point. I just met with one company earlier today who said this volatility is even worse than what they experienced during the pandemic. So that just shows you, how they are really still trying to figure out the rules of the game before they can put together a game plan. And unfortunately, when you run the numbers, even assuming some mitigating efforts like taking pricing, the impact on a lot of the companies that I look at, specifically in the apparel and footwear categories, is very significant.
It's interesting that you mentioned that in terms of volatility, uncertainty, you're saying that this is worse than it was in the pandemic, one of the most unprecedented time periods. What are you hearing from people? Does it seem as though in the data looking forward that maybe consumers have more to brace for?
Yes, absolutely. I think that if the worst case, tariffs that we heard from the president on Liberation Day do go through, we will see significant price increases across the board. And I think that just puts greater risk on consumers being able to spend on discretionary goods. We're still coming out of the pandemic where we were seeing demand normalization and deflation in a lot of bigger ticket categories. And so I think, of course, we still have to see what the final results are. But in my view, the 90-day pause does not really change the end result. There are still no easy answers as to how the companies will mitigate these higher costs. And I think as a result of that, a lot of them will end up flowing through to the consumer in the form of higher inflation.
Are there certain categories, Mary, that retailers can pass along the cost increases more readily than in some other areas, historically speaking?
It's a great question. I think it's a little bit harder to talk category. It's easier to talk brand because, of course, there are certain companies that have been performing very well, have very strong brand momentum and product innovation. So in that group, I would highlight like a name like Tapestry, where there's still a big white space pricing opportunity between themselves and the luxury categories. I think a brand like Ralph Lauren, even in apparel, which is typically a low growth category, they've been taking a lot of share. I think beauty is still a category where consumers are willing to spend on new innovation. Outside of that, it's harder to identify areas where I think the companies will be able to pass through higher pricing without seeing a negative impact on unit demand.
All right, very good. Mari Shore, thank you so much for joining us. Mari is a senior equity analyst at Columbia Threadneedle up there in Boston, joining us via Zoom. It just feels that if they can, I would think pretty much most retailers would try to push along as much.
Oh, most definitely. I mean, why wouldn't you in this scenario?
No, and we saw that, during initial stages of inflation several years ago, and we're still feeling it. I mean, the prices we're paying in the supermarket and other areas, they don't come down very much. I mean, unless it's a commodity like the price of eggs or something.
Right.
But
I was speaking to a source of mine, actually, a retail REIT, and they were saying that they're speaking to a lot of their tenants, and they do plan to pass on these costs because what else is there to do for them?
Yep. All right. Very good. Coming up, Shayna Sissel. She's going to join us. She's over there at Banrion Capital Management. Get her thoughts on these markets. And Michael Shepard, Bloomberg senior editor in Washington, D.C. He'll give us the latest reporting on the U.S. China technology. So we've got that all coming up. We'll take a look at the markets here. We have selling. We got the S&P off 55 points. That's 1%. Selling's more pronounced than the tech-heavy NASDAQ. That's down 315 points. That's 1.9%. The Dow's doing better, only down about 0.25%. The VIX sitting steady right at 30. Yield space coming in just a tick here. We got the 10-year Treasury yielding 4.32%. Gold higher, $80 higher. This is good.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. U.S. retail sales rose substantially in March on a jump in car purchases, suggesting consumers were scrambling to get ahead of punitive auto tariffs. The value of retail purchases, not adjusted for inflation, increased 1.4%, the most in more than 2 years. A global stock sell-off occurred after the World Trade Organization cut its forecast for merchandise trade this year, citing the U.S.-led trade war. That tech sell-off plus the WTO forecast moving stocks lower at this hour. We do check markets for you all day long at Bloomberg. The S&P 500 is down 0.9%. NASDAQ is down 1.8%. The Dow down about 0.2%. The 10-year Treasury yield at 4.32% and the 2-year yield at 3.8%. Bloomberg Dollar Spot Index down 0.7%. Gold is more than 2.5% higher. Brent crude up 1.7%. WTI up nearly 2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Bloomberg Intelligence with Paul Sweeney and Norma Linda.
All right, Amy Morris, thank you so much. We appreciate that. Norma Linda, sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. Let's get right to it. Shana Sissel joins us, President and CEO of Banrion Capital Management. She's in Chicago, joining us via Zoom. Shana, what kind of conversations have you been having with your clients given this extreme volatility over the last several weeks here?
So my company, obviously, we focus on the alternative space. So the vast majority of our conversations have been helping advisors talk to their clients about how alternative investment strategies, specifically ones that are low to no correlation, can help in their portfolios kind of help to dampen some of the volatility and different ways in which they can use alternatives to kind of have more productive conversations with clients and help them get more comfortable with what's going on in the market, because we think that going forward that this volatility is here to stay for a while. And so it's all about having productive conversations on how to kind of address the volatility, especially for clients that are getting closer to an endpoint like retirement or something of that nature.
So people have been talking a lot about potential stagflation fears. What is data telling you is really the risk there? What are you hearing from people? And how would you advise your clients in that type of environment in terms of alternative investments?
So stagflation is a real risk. It's the idea that inflation is higher than GDP, actual economic growth. There is the potential for that to happen, especially with the tariffs. I know the Fed has said that they believe that the tariffs impact on inflation could be, quote, transitory, which using that word, I think, is a mistake. I think we've already learned that. I think that could very well lead to stagflation, because I don't think it's necessarily going to be transitory. But I also am not convinced that the tariff policies that are being threatened are the tariff policies that will actually go into place. And time and time again, we've seen that with this administration. In terms of how that impacts alternatives, is we're looking at things that are going to be able to address the volatility of portfolios. So that's things like market neutral, long, short, directional, equity, hedged equity, managed futures, global macro, anything with an arbitrage aspect, anything that has a hedge. And those products have actually done quite well. We took a look at some of our partners, and so we have a number of ETF partners that we work with, and all of their products are outperforming the market substantially, with the leader in that space being an equity market neutral product, ticker symbol BTAL. Again, they're a partner of ours, but that product has done incredibly well through this. And so those are the conversations we're having. They're the easiest things to kind of implement on the fly. The private products take some time, so we're looking at quick implementation of products in order to dampen some of the volatility.
So, to the extent that alternatives do provide a non-correlated return, what's the best way to play it? Is it through the ETF market, Shana?
Right now, I think it is. So there's a number of ETFs that do hedge fund-like strategies, and ultimately those are the ones that you would want to look at. The same is true in the private markets. You want to look at hedge fund-like strategies, not necessarily private equity, private credit. Those things move in lockstep with their public counterparts, even though it's at a lag and they don't mark to market, they do have correlation there. So we're looking at, say, managed futures like a CTA. As I mentioned, BTAL. There's CBLS, which is a directional long short, MRSK, which is options strategy using put options, so it has a hedge aspect, RDFI, which is a closed-end fund arbitrage fund. Things of that nature is what we're really focusing on. Those are the ones that have done quite well. I took a look at them last week, preparing something for our clients, and all of those products have outperformed the market, some more than others, but they are all low to no correlation. They all have a hedge, and they're all designed to help to mitigate volatility in the markets. These things hadn't been particularly popular until recently, and now we're seeing, equities and fixed income move in conjunction with each other, which is not how we build portfolios. We build portfolios thinking fixed income and equity will not move in the same direction at the same time, but that's not what we're seeing. And that actually makes what the Fed decides to do in May all that much more important, because the Treasury market, I think, is more concerning, and the rates going up with Treasury yields is more concerning than, say, the equity market's volatility, because portfolios traditionally are designed with that 60-40 mix, and when both the 60 and the 40 are going down at the same time, you really need this alternative sleeve in order to kind of mitigate that volatility that you're seeing in that and kind of protect on the downside.
Yeah, it reminds us a little bit of 2022 when both stocks and bonds went south. Shana Sissel, thank you so much for joining us. We always appreciate getting a few minutes of your time talking about alternative investments here, and maybe in this type of environment, they can play a leading role here for a lot of folks out there. Shana Sissel, she's the president and CEO of Banrion Capital Management. She's out there in Chicago. If you're looking at company news today, one of the big items crossing the table is that NVIDIA they're warning that the President Trump's curbs on China chips, it's going to cost it $5.5 billion. That's the write-down they are taking on some of their chips that are no longer commercially viable in China, at least under the current tariff situation. So let's get the latest reporting there and where else we might see some risk for companies out there. Michael Shepard, Bloomberg senior editor in Washington, D.C., joins us here. Michael, what did you make of the news out of NVIDIA? And can you extrapolate it out to other companies, other sectors maybe?
Well, we already see one extrapolation playing out in the market today, Paul, and that is advanced micro devices. NVIDIA told the world yesterday it was facing this charge related to the new restrictions from the Trump administrations on sales of its H20 chip to China. But now AMD comes out today and says it too is facing similar curbs on its ability to sell a similar product, a device known as the MI308. Both of these were designed to comply with previous U.S. curbs and restrictions on sales of advanced microprocessors to China. And the idea of those limits is that you don't, officials here in Washington don't want China's government or Chinese companies to gain too much of a technological edge when it comes to products that could have dual use for the military or potentially give Beijing a leg up in this race for artificial intelligence. So we are hearing from it, and other companies will have to keep their eye out for further restrictions, especially, Paul, as we see this trade war intensifying.
So no one wants to hear this type of news, especially for AI darlings, someone like NVIDIA, especially with tariff uncertainty and the degree of those impacts still unknown. What is the environment like in Washington? What are people hearing in regards to this whole tariff story?
Well, it's a great question because we really see this as much of as part of a larger narrative here in the nation's capital. Hawkishness towards China has been growing over the past several years. Both Republicans and Democrats have viewed the world's second largest economy as much more of a rival rather than as purely a trading partner. And they have unified in this approach of trying to restrict access to sensitive technology, not just semiconductors, but also the equipment used to make them. And so this is not a real sea change here that we're seeing today. Rather, it is just another step in a direction of travel we have been following. Now, the question was whether some of the big tech companies and their CEOs who have tried to make pleas to Donald Trump, including Jensen Huang of NVIDIA, who was at the White House just a few weeks ago, those pleas for maybe a break on some of these export restrictions, it's not so much that they've fallen on deaf ears, it is just that policymakers inside the Trump administration have really decided that they need to stay the course in getting tough with China.
You know, you mentioned, Michael, this has been just another step, maybe a big step, but another step in what's kind of been developing over the last several years, which I've kind of likened to a technology Cold War between China and the U.S. and maybe even China and the West in general here. Is there any way to get off this track here, or is this just where we're going?
Well, it's a tough track to escape because we did see overnight our colleagues in Asia scooped that China is willing to talk with the Trump administration, but they are setting some terms for how they want that conversation to unfold. And this is much more than just the conversation that President Donald Trump might want to have on tariffs. His spokesperson said yesterday the ball is in Beijing's court. Well, Beijing volleyed back with an indication that they are setting some terms for having this discussion. One, they would like to see one-point person, not the President of the United States, but one of his top aides, serving as the main interlocutor with Beijing so that they could negotiate something. Two, they really want to make sure that these technology curbs are part of the conversation, as well as, you know, the eternally contentious question of Taiwan. And then three, they would like to see some of the more disparaging rhetoric coming from some Trump administration officials, including J.D. Vance, comments that officials in Beijing have not taken too well. They want to see that dialed down. But we're a long way off from seeing the two sides actually taking a step toward meeting the way that we saw earlier this week. The European Commission's top trade negotiator was in town to have those kinds of conversations. We're a long way from seeing that take place with the Chinese right now.
I mean, we also saw news that Trump says that he will attend tariff talks with Japan today. What are we hearing is really the urgency from maybe legislators and other people in Washington to really get these trade relations sorted out with some of our biggest trade partners?
Well, they certainly are under some pressure to act, and members of Congress are increasingly concerned that, you know, this sweeping tariffs package from the Trump administration could carry some economic blowback that would be felt in their districts and could make it hard for them to win re-election in the upcoming congressional elections in 2026. And they're also worried about how the blowback from that could affect their districts and their standing, too, with the folks back home. They've already been hearing from constituents that there may be job losses, not only through tariffs, but also the administration's push to cut a lot of federal employees from the government's workforce, too.
Michael, thank you so much for your reporting. Really appreciate your time. Michael Shepard, senior editor for Bloomberg News, giving us the latest on kind of what we're seeing coming out of these technology negotiations between the U.S. and China. Again, we're starting to see some of the costs come here. AMD putting out some numbers, and of course, NVIDIA yesterday citing $5.5 billion write-down on some chips that they will no longer be selling to Japan. So it's getting real for a lot of companies out there, and we will stay on top of that. David Boreakos is coming up, Bloomberg legal reporter. Give us the latest on what's happening with Harvard and their fight with the Trump administration. That's coming up in just a moment. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Amy Morris. Advanced Micro Devices expects to be charged as much as $800 million after the Trump administration put new restrictions on semiconductor exports to China. The company came to that conclusion after it completed an initial assessment of a new license requirement for the export of its M1308 products. NVIDIA said yesterday it'll take a write-down of $5.5 billion because its H2O chip will be banned from export to China without a license. AMD says it will seek licenses to export to customers in China. It just can't be sure it will get them. Shares of AMD right now nearly 6% lower. Shares of NVIDIA more than 6% lower. We do check markets for you all day long here at Bloomberg. The S&P 500 down 0.8%, NASDAQ down 1.6%, the Dow down 0.1%, the 10-year Treasury yield at 4.31%, the 2-year yield at 3.8%. UBS senior strategist Nadia Lavelle sees some degree of certainty returning to the markets.
We are past the peak level of policy uncertainty. And of course, yes, there's still a lot of fog, but we think that the market is more prone to positive headline risk at the moment around tariffs, and that could get priced in pretty quickly.
UBS senior strategist Nadia Lavelle. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Bloomberg Intelligence with Paul Sweeney and Nora Melinda.
All right, Amy Morris, thank you so much. We appreciate that. Nora Melinda is sitting in for Alex Steele. Alex will be back next week. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so you can head over to YouTube.com, search Bloomberg Radio Live, Bloomberg Podcast Live. Either way, we'll get you to where you need to go. All right, here's what I understand of this whole Harvard thing with the Trump administration. The latest is the Trump administration has frozen $2.2 billion in grants to Harvard, citing concerns over anti-Semitism and pro-Palestinian protests on campus. And Harvard's hired an attorney, and this is an interesting hire to represent it. And it's a great story in the Bloomberg Terminal, one of the most widely read about this attorney. David Viriakos joins us. He's a legal reporter for Bloomberg News. He joins us live here in our Bloomberg Interactive Broker Studio. So who did they hire? Who was this William Burke fella?
Bill Burke works at Quinn Emanuel in Washington, and he has very close ties to the Trump administration and in conservative legal circles generally.
Really?
He's represented a lot of billionaires and different people in political settings in the Trump world. And he's considered to be an excellent courtroom advocate and also a very skilled negotiator. So by hiring Bill Burke, Harvard is essentially saying this is someone who we think has real skills to help us with the Trump administration.
Mm-hmm. So legally, what can Harvard really do here? I mean, how much leverage and stuff does Trump have? Is he allowed to do this? What are the legalities here?
Well, that's the question. Can they withhold billions of dollars in federal funding the way they have done? Harvard says that that is not in compliance with the law, and the Trump administration says that it is. It could end up in a lawsuit in federal court, and a judge would determine whether they're following the correct law.
Mm-hmm. So it's never a good strategy to sue the U.S. government, in my opinion. I mean, it just seems like that's a tough road to hoe. What is the strategy for Harvard? How far do they want to take this? How do you think this plays out?
Well, suing the government sometimes works, and it has worked in the second Trump administration for a number of plaintiffs. But I think that the real strategy is to negotiate, and you can either negotiate with or without a lawsuit. A lawsuit can begin a process of negotiations, and I think Harvard would concede that probably that they have some ability to withhold money, but not all the money that they are withholding.
So, taking it to the federal government can take a while. Is it worth it? I mean, $2.2 billion sounds like a lot to me, but is this money that Harvard really needs?
I think Harvard would say that it is, that it's been very important money for their medical research, for their engineering research, and other aspects of the university. Obviously, they're the wealthiest U.S. universities, so they could withstand not having that money for a while and withstand a protracted legal fight in a way that other colleges and universities may not be able to do. But I mean, their questions revolve around the procedure by which the money was withheld, and also First Amendment questions. They say that under the First Amendment law, it's clear that you know, their activities and speech are protected, and so that this is illegal retaliation.
So, I mean, I just had this whole economics of government investment in universities explained to me over the weekend. I wasn't really clear, but this is a government giving money to a university, and it's not just Harvard, it's University of Texas, University of Florida, whatever, all these state universities, huge research grant universities, Penn State University. They're investing in these universities. They're investing in the research and development of these universities, the labs, all that kind of stuff, so that the U.S. can develop cool new stuff, whether it's medicines or technologies. So it's an investment by the U.S. government, and they're saying, who's going to do all this research and development for us? Well, let's use the scientists that are already on these campuses and already have these labs there. That's kind of what developed post-World War II. And that's been and that has created all the great technology and advancements that the U.S. government's had, right?
Right. The argument is that these are investments that help the entire nation, not just that private university, that they are directed investments that help push cutting-edge developments in a number of areas, and that there is a benefit to it. The Trump administration says that those investments can't be made with no strings attached, that there are essentially important strings that involve following civil rights law. And their position is that Harvard is not following existing civil rights law.
Got it.
So the question is, how much leverage does the government really have over Harvard? And that's what we're waiting to find out.
So are people expecting, we've seen other universities, we've seen Trump say something and then they kind of buckle, they cower, and they let it go. That being said, are we expecting this with Harvard? Do we expect them to remain steadfast on this journey against, the U.S. government, or are people thinking that they may end up backing down?
Well, that's what we're waiting to find out. I mean, the position that Harvard's taking now is that we refuse your demands, and we're going to sit tight and fight you, and they will do that until they don't. I'm sure that it's a bit of a negotiating position, and we'll see what they're able to extract in the weeks and months ahead.
So Harvard's hired this high-profile attorney, but they have not yet sued the U.S. government. Is that a decision they could take, and what would they sue for? Just to block them?
A lawsuit seems like a distinct possibility. It hasn't happened yet. Essentially, they have two arguments, as I understand it, which they've outlined in letters to the government. One is that this is a violation of their protected First Amendment rights, and the other is that the government did not follow the correct procedure in withholding this money. So both of those are viable legal claims that could work in a federal court. It depends on how they're argued and how the judge views it.
Sorry, so we'll be on, well, I guess we'll just kind of wait and see. Kind of the next step is ball's probably in Harvard's court, right?
At this point, it seems like the ball is in Harvard's court, because earlier this week, the federal government froze the $2.2 billion that they had promised to Harvard, and now the question is, what is Harvard's reaction going to be?
Every other university is just holding its breath, keep its head down. David Voriakos, legal reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio, giving us the latest reported here, reporting on this fight between Harvard and the Trump administration. Again, the latest news is Harvard has hired a pretty high-profile attorney with strong, I guess, conservative bona fides, and with the relationship with many folks within the Trump administration, maybe that will be helpful to maybe gaining some resolution here. Markets continue to sell off here. The S&P 500 is off 52 points. That's about 1%. And the NASDAQ's off about 1% here as well. Coming up, we'll have some more reporting on this market as we continue to deal with high volatility. We'll have more coming up in this report.
is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, we have Norma and Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and find us over there. We're talking about one of the big stories here in the last really couple of years has been obviously the growth of AI, but then what are some of the ancillary plays of AI? One of them, surprisingly, at least to me, probably not to Alex Steele, is energy. Apparently you're going to need a lot of energy to power all these data centers that are going to be required. And what does that mean? How are these companies going to power these data centers? That's going to be a big issue. Helen Koo joins us, head of U.S. Power Markets Research at Bloomberg NEF, joining us from San Francisco via Zoom here. Helen, thanks so much for joining us here. Talk to us about this market here for data centers. How big is it? How much is it going to grow? And what are the energy implications there for these data centers?
Yeah, thank you so much for having me. So Bloomberg NEF, we just published this really, really big research report on AI power demand. And in this report, the first question we try to answer is just how much data center build is going to happen in the United States. And at BNEF, what we expect is that U.S. data center power demand is going to more than double by 2035. It's increasing from 34.7 gigawatts in 2024 to 78.2 gigawatts in total power load. If that's a whole lot of jargon words, that's roughly around 35 million homes of power. So that's a lot of new demand.
Helen, really great research here. Who exactly is building these data centers? What are some of the names?
Oh, thinks we might have lost Helen. At least we lost the audio. Okay,
oh,
we lost her.
Can you hear me now?
There we go. There we go.
Good. Who's building these data centers? What are some of the names?
Yeah, so there are 4 major tech companies that are building these data centers. So you have Google, Meta, Amazon, and Microsoft. They make up roughly 43% of the current data center fleet in 2024. And they are also the same companies that are developing large language models that would need AI training data centers. What's really unique about the data center industry is that it's dominated by these very highly consolidated companies with a lot of resources and capital. And so what that means is this industry wields a lot of influence over the energy infrastructure and planning and investments of power markets.
So how do you power these things? Because my understanding is these computers inside these data centers, they're cranking all the time and they need a lot of energy there. Are they just going to tap into the existing grid? Do they need to be self-powered? How's that all going to work?
Yeah, so in our report, we do explore a little bit on how these data centers are going to be powered. What we know and what we focus on mainly in the report is mostly on the fundamentals and drivers of growth for data center demand. What we know is that in the US, this demand is resulting in a lot of kind of ways and innovations in how these data centers are thinking about powering these assets. For the most part, we believe that these data centers are going to be powered through the power grid, but we're also seeing a lot of new kind of innovations like co-locating data centers. We're seeing data centers kind of being positioned in remote locations, specifically near stranded renewable assets, or maybe on-site power, kind of specifically data centers with on-site power generation online. But for the vast majority, these data centers will be powered on the grid.
Mm-hmm. So how has DeepSeek, if at all, changed or influenced AI training data center demand?
Yeah, that is probably the most asked questions we get on the power team. So there was previously an assumption that AI training data center power consumption was highly correlated with kind of the complexity of large language models. So it's basically the number of parameters a model is trained on. And the industry was really worried that the energy intensity of an AI training data center would only go up as models get more complex. DeepSeek V3, in their technical paper, which was published in December of 2024, what it uses is a mixture of experts training process. If that is doesn't mean a lot to most people. What it does is that it basically limits the number of parameters used to train during a specific query. So the number of parameters that it uses when it's asked a training question is smaller, and therefore it uses less energy. That broke the assumption that like specifically complicated large language models must use a lot of energy to be really, really good large language models. So we know that AI training data centers just act like any other power demand class. With innovation, you kind of reduce energy intensity in the long run. So it's not a runaway energy intensity technology.
Helen, thanks so much for this. Really appreciate getting your thoughts here on a really interesting topic. Helen Koo, head of U.S. Power Markets Research for Bloomberg NEF. She's based out there in San Francisco, so I appreciate getting a few minutes of her time. But again, I've even heard some of these things put a little kind of small nuclear reactor right next, power up a bunch of these data centers. Maybe
Right.
that's a solution. But and I know a lot of these big data companies like Google, Microsoft, they want to power these things as cleanly as possible.
Exactly.
But there still is going to be a need for fossil fuels, I would think.
Ever evolving.
Yep, ever evolving. That's true. So, all right, markets selling off. S&P's off 63 points, 1.2%. We've got the NASDAQ off 2%. Thank you very much, Nora, for joining us.
Fun times.
Enjoy your long weekend. Alex Steele will be back with us on Monday, and that does it for us. Balance of Power with Kaylee Lines is next after this global news update as we look at a market that continues to sell off. Well, more coming up. This is Bloomberg.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. The Trump administration is suing the state of Maine for not complying with the federal effort to ban transgender athletes from girls' and women's sports. Attorney General Pam Bondi.
This is about sports. This is also about these young women's personal safety.
Maine's governor calls it a pressure campaign to get the state to violate its own human rights laws. CBS's Jake Rosen.
What the Trump administration wants in this is restitution paid to the female athletes that were hurt by this. They want potential fines paid by the state of Maine, as well as forcing compliance with this, basically holding the threat of financial funding for Maine schools and other entities across Maine that receive federal funding over the governor's head as they kind of go through these court cases, and at least in this case, a real court filing, not just a threat from President Trump.
President Trump says he'll attend a meeting today with a top Japanese official in the midst of his trade war. CBS's Nancy Cordes.
They have sent a top negotiator here to the U.S. who will be meeting with the Treasury Secretary. They obviously send a lot of cars to the United States. The U.S. sends a lot of agricultural products to them. But one of the things that President Trump has complained about is that the Japanese don't buy enough American cars.
A government report says retail sales were up 1.4% last month, with car dealers seeing a more than 5% spike. CBS's Jill Schlesinger.
This report shows that people were very worried that car prices and truck prices would rise as a result of those 25% tariffs.
Maryland Democrat Chris Van Hollen has just arrived in El Salvador. He says he wants to meet with officials about the man deported there by mistake, Kilmar Abrego Garcia.
This is about the rule of law. This is about due